Namaste, Namaskara, Vanakkam. Guys, I welcome you all to CA Inter Income Tax Exam Day Revision for Jan 2026 attempt, guys. If you think you do not have conceptual clarity, or you are not able to recall the provisions of income tax subject, or you have very less time on hand and you are worried, how will I revise the whole income tax syllabus just within 1.5 days before the examination, guys? Don't worry at all. Be in this video till the end, guys, and I can with the guarantee can say, guys, out of your 50 marks of income tax paper, at least minimum to minimum 40 marks will be covered from this revision video only, guys. I can say this with the full confidence, guys. Now, what is the agenda of this video? Very simple. I am going to cover first the basic concepts, then I'll be moving on to residential status, then all 5 heads of income will be covering, then clubbing of income, set of carry forward of losses, TDS, TCS and total income. Guys, you can see from here, minimum 45 marks out of your 50 marker paper is already covered in this marathon revision video only, guys. Pakka, I can say this, guys. Now, you need to understand first of all what is the question paper pattern of income tax syllabus, guys. First of all, for MCQs, you will be asked for 15 marks. In that MCQs, generally it is seen from the past 5 attempts question papers, you check and analyze, guys. Agriculture income, house property, set off and carry forward of losses, clubbing and IFOS. These are the very much liked topics which is generally very frequently asked by ICI for the MCQs, guys. So definitely all these concepts will be covered in this marathon revision. Coming to the descriptive questions, guys. Question number 1. You take last 5 attempts question papers. Question number 1 is definitely every attempt asked from the total income computation, which is nothing but a mixed masala of all the concepts which are there in the income tax law. So total income computation question is pakka 15 mark question, definitely they'll ask you. Question number 2A, every attempt 99% chances are there. Residential status only they will ask for 6 marks, guys. Question number 2B, every attempt you will check. You check the last 5 attempts question papers, TDS or TCS, minimum 4 marks is definitely asked, guys. And question number 3A and 3B, it is generally asked from capital gains, IFOS and salary. Some or the other topics will be covered from this and it is asked for 10 marker, both 3A and 3B put together. Now coming to question number 4A, all the attempts, guys, set off and carry forward of losses only it is asked for 6 marks, guys. And question number 4B, every attempt from return of income, a theory question is asked for 4 marks. So as we already know that which are the topics will be covered from a particular question, we can definitely target these particular questions and topics and we can cover the maximum syllabus in this revision video only. So if you want to download the PDF which I am using in the screen, you can see on the screen, you can just click on the drive link which is provided in this video's description. You can download it, guys, and I request you to please do subscribe to my channel, because for your examination tomorrow also I am going to come up with amazing videos, guys. And please do like this video and share with your friends, and finally don't forget to comment and let me know how my marathon revision was. Yes, so the first topic which we are going to discuss is basic concepts, guys. Guys, the intention of the whole income tax paper itself is to find out the tax liability. So tax liability generally has 3 components, guys. Number 1, it is basic tax. Number 2, it is surcharge. And number 3, it is health and education cess. Guys, in basic tax, we have 2 kinds of taxes: normal tax and special tax. Normal tax is levied on normal income and special tax is levied on special incomes. What are the special incomes, sir? Very simple. 111A, short-term capital gain. 112A, long-term capital gain. These are the special incomes on which we calculate the special tax at the rate of special tax rate which was provided. So this is nothing but your basic tax. On that basic tax, sometimes we are required to add surcharge. Mind you, surcharge is applicable only if your total income is exceeding 50 lakh rupees. If your total income is not exceeding 50 lakh rupees, in the case of individual, we do not levy the surcharge, guys. Surcharge is nothing but an additional tax apart from the basic tax liability, guys. This is only levied only if the total income is more than 50 lakh rupees. Mind you guys, every time keep in mind one thing, this surcharge, don't never go and compute the surcharge on the total income. You need to compute the surcharge on the basic tax liability which you will compute. So on the basic tax liability, whatever you will compute, on that you will add 10%, 15%, 25%, 37%, whatever surcharge rate on the basic tax liability you will compute. Never compute on your total income, mind you this. Health and education cess at the rate of 4% we compute on the basic tax plus surcharge, guys. Never compute this health and education cess directly on total income, guys. You have to always first take the basic tax, add surcharge, on this total you will compute 4% of health and education cess. Sir, what if there is no surcharge, sir? If there is zero surcharge, then very simple. On basic tax, you calculate 4%. Guys, mind you, health and education cess is mandatory. In every case, you need to add health and education cess. But surcharge is not mandatory. Surcharge will depend on what is your total income. Only if your total income is more than 50 lakh rupees, you will apply surcharge. Yes, so charge on basic tax plus surcharge is health and education cess. So if I have to simplify, income tax or total tax liability is nothing but your basic tax plus surcharge plus health and education cess. Now, sir, what are the basic tax rates, sir? Mind you guys, when I say basic tax rate, I already told you there are two kinds of basic taxes. One is normal basic tax, the other is special basic tax. Special tax is directly you have to apply special tax rate under 111A section 112, a. This basic tax rates which I am going to discuss here is on the normal income only, guys, is on only the normal income only. Now, mind you, for individual HE of AOP, BY, AJP, for everyone put together, the basic tax rates are same. But, mind you guys, individual HE of AOP, BY, AJP are generally required to pay tax under the default tax regime. Are generally required to pay tax under the default tax regime under section 115 BAC. But if these persons wish to not to pay tax under default tax regime, they can pay tax under optional tax regime. I repeat, generally these persons are required to pay tax under default tax regime, but if they want to opt out of the default tax regime, they can pay tax under the optional tax regime, guys. Now keep in mind one very important thing, the difference between default tax regime and optional tax regime. Default tax regime, generally you will find that the tax rates are low, whereas optional tax regime you will find tax rates are high. Under default tax regime, less benefits of exemptions and deductions they will give, because already the tax rates are low here, so you will enjoy very less benefits of exemptions and deductions. But mind you, under optional tax regime, since the tax rates are high here, you will also enjoy the high benefits of exemptions and deductions. And one more thing, under the default tax regime, guys, the tax rates for normal person, senior citizen, super senior, resident, non-resident, any person, guys, it is the same slab rate given. But under the optional tax regime, the slab rate is different for a normal person, the slab rate is different for a senior citizen, the slab rate is different for a super senior citizen, guys. Now let's look at the slab rates which are provided under default tax regime and optional tax regime. Mind you guys, again I repeat, these basic tax rates never apply on 111A, 112A and 112, and these are slab rates. As your income increases, your tax rate also increases, and only on normal income we will apply this. Now first, under default tax regime, guys, under section 115 BAC, for individual HE of AOP, BY, AJP, the slab rate is something like this. Up to 3 lakhs of income, there is no tax, nil or 0%. From 3 lakhs to 7 lakhs, it is 5%, 7 lakhs to 10 lakhs, 10%, 10 to 12, it is 15, 12 to 15, 20, and 15 lakhs above, it is 30%, guys. Under optional tax regime, on normal income, for individual HE of AOP, BY, AJP, resident plus non-resident also, guys. Mind you, in this slab rate, 2% are excluded. Number 1, senior citizen resident. Number 2, super senior citizen resident. Yes, only these 2% are not eligible for this slab rate. Rest all individuals will fall under this slab rate only, guys. Under this slab rate, the basic exemption limit given is 2,50,000. So up to 2,50,000, absolutely there is no tax liability. 250 to 5 lakhs 5%, 5 lakhs to 10 lakhs 20%, and above 10 lakhs it is going to be 30%. Now mind you guys, under the optional tax regime, if you are a senior citizen and that too you are a resident only, you will apply this slab rate. If you are a senior citizen, in questions lot of times guys in examination, they will give age more than 60, but mind you, somewhere in the question they will tell the person is non-resident. If you only focus on the age and don't focus on the residential status, and by mistake you apply this slab rate, gone, you will get sunyam in examination, guys. Definitely you need to focus on two facts. Number one, senior citizen, and number two is resident. Only if the person is resident and senior citizen, in that case you will apply the higher basic exemption limit of 3 lakh rupees. Now, who is a senior citizen? If the age is 60 years or more, but less than 80 years, that person will be called as senior citizen. Now, who is a super senior citizen? The person who is aged 80 years or above will be called a super senior citizen. And mind you, here also this person shall be definitely a resident only. Only then this basic exemption limit, higher basic exemption limit of 5 lakhs you will give. Sir, what if in the question super senior citizen only, sir, age more than 80 only, but the person is non-resident, sir, which slab rate I should apply? Don't apply this slab rate. Go and apply this slab rate, guys. Are you getting it? Next. Guys, mind you, in examination, in the question paper, sometimes directly they will not give you compute the tax liability under default tax regime, compute the tax liability under optional tax regime. Directly they may not give you. They will try to tweak and twist the language because you should get confused and you should definitely fail in the examination. They will try like that. First of all, the language which will be used is compute tax in the most beneficial manner, it will tell. So if the most beneficial manner means very simple, you need to compute the tax liability under both the tax regime, guys. Because mind you, I told you already, generally individual or HUF AOP BOI is required to pay tax under default tax regime only. But if for this person optional tax regime is more beneficial, then why he will pay tax under default tax regime? Correct. So in the question, if it is given that compute, the language used in the question is compute tax in the most beneficial manner. Mind you guys, you are required to compute the tax liability under both the tax regimes, default and optional tax regime. But if the question says assessee wishes to opt out of default tax regime, it means that you are required to compute the tax liability under optional tax regime, guys. So assessee wishes to opt out of default tax regime. Opt out means he is not required to pay tax under default tax regime. He will pay tax under optional tax regime. A person has exercised the option of shifting out of default tax regime. This is one more language used. It is here trying to ask you to compute the tax liability under optional tax regime here also, because here it is saying shifting out of default tax regime. So there are only two regimes, default and optional. If you are shifting out of default, obviously you will compute tax under the optional tax regime only, guys. The next concept is surcharge. Mind you, I already told you, surcharge you do not compute on all cases. You compute surcharge only in the case where the total income is going beyond 50 lakh rupees. And mind you guys, never compute surcharge on the total income. You will compute the surcharge on the basic tax liability only, guys. Now surcharge levied only if total income is more than 50 lakhs and levied on basic tax liability only. Now guys, keep in mind one thing. Exactly like the income tax slab rates, here also surcharge rates are given. But mind you, these are not slab rates, guys. It means that, let's say for example, your total income is 60 lakh rupees. In that case, straight away, if your total income is 60 lakh rupees, you straight away fall in this category and you will apply 10% surcharge on the basic tax liability. If your total income is somewhere 1.5 crores, you will apply surcharge rate of 15%. So this slab rate, whatever is given, is just to pick the right surcharge rate. Don't apply the incremental income like that concept here, which we apply in the basic tax liability as per the slab rate. Don't apply that concept. This is just to pick the right surcharge rate and directly apply, guys. Okay, now total income you have to always check. what is your total income. Mind you guys, when I say total income, it does not only mean normal income, it means both normal income and special income. Whenever I say total income guys, you will check whenever you want to pick the right surcharge rate, you will always check the total income, not only the normal income. So total income is nothing but normal income plus special income put together. Whatever is your total income, based on that you will pick the surcharge rate. Mind you guys, under optional tax regime and default tax regime, separate surcharge rates are given, but there is one small twist, that's all. Under optional tax regime and default tax regime, almost the surcharge rates are same, but just that at the end, if your total income exceeds 5 crore rupees, only in that case guys, the surcharge rate under the default tax regime remains 25% only, but under optional tax regime, higher surcharge rate of 37% is levied. So if I have to simplify in single line guys, under optional tax regime the highest surcharge rate is 37%, under default tax regime the highest surcharge rate is 25% only guys. Are you getting it? Now I already told you how to pick the surcharge rate. If your total income is 60 lakhs, 70 lakhs, somewhere more than 50 lakhs up to 1 crore, pick this 10%. If your total income is, say for example 1.5 crores, pick this 15% under whichever regime you are and compute on the basic tax liability. But guys, keep in mind one thing, rate of surcharge on special income shall not exceed 15% under any tax regime. I already told you total income will have two components, normal income and special income. And now what is this provision saying is, rate of surcharge on the special income shall not exceed 15%. Guys, simply one logic I'll tell you guys, one dialogue I'll teach you. Just remember this dialogue in examination. You will crack any kind of surcharge kind of complication guys. Number one dialogue I'm going to tell you is, if your total income, when I say total income, both normal income, special income together, if it is up to 2 crores guys, don't think anything guys, simply whatever your total income is there, if it is up to 2 crores guys, up to 2 crores, directly go and check in this slab and pick the right surcharge rate, no problem, no problem. But the problem arises when your total income goes beyond 2 crores. Only if your total income goes beyond 2 crores and in a total income you have special income component also in that. I repeat, if your total income exceeds 2 crores and your total income also has special income, in that case you will do this simple two steps guys. Number one, surcharge on special income flat 50% you apply guys. On a special income, whatever special basic tax rate you will calculate, no, on that you add flat 15%. Don't think anything, don't look at how much amount of special income you have, flat 15% you apply guys on special basic tax. And surcharge on the balance normal income, the basic tax liability of the normal income is there, no, on that you make sure minimum 15% you are applying the surcharge rate, and you check the limit separately guys. Separately you take the other normal income, whatever normal income is there you will take, and you will come here and in this table you will check again the limit. Let's say for example the normal income which you have is 60 lakh rupees you have, and here 10% is coming. You will not give 10%. What I told you here, minimum 15% you will apply. So if your normal income separately, you take normal income and again recheck your normal income where it falls. If your normal income falls here, no problem, 15% you are anyway given, minimum term I am using. So guys, very simple, two dialogues. Remember, if total income is less than or equal to 2 crores, up to 2 crores your total income is, then no need to do all this adjustment. Simply pick your right, then surcharge rate from normal income and special income shall be same. Pick from this table directly. But if your total income exceeds 2 crores and also includes a special income, then surcharge on special income flat to 15%, surcharge on balance normal income minimum 15% you have to apply. Check the limit separately for balance normal income guys. Now, sir, what are the special income, sir? Guys, mind you, generally special income means only three: triple one A, double one two, double one two A, winnings and all. But guys, here triple one A, double one two A, double one two, and dividend income also will be considered as special income only. Don't please consider winning income and all. Only these four items you considered as special income for the purpose of surcharge. Now, the next concept is marginal relief, guys. Marginal relief concept will apply only when you have surcharge concept, guys. Find out tax before cess on below. Whenever you apply marginal relief, always you apply before the education cess, health and education cess. Now I'll explain you with a beautiful example. Let's say your total income is 50 lakhs only. Do you apply surcharge when your total income is 50 lakhs? No, we apply surcharge only when the total income exceeds 50 lakh rupees, correct? Now here see, if your total income is 50 lakh rupees and the basic tax liability will come this much, surcharge of course we will not add anything, Sunyam will come, so total tax liability is 13 lakh 12,500. But I'll take one more scenario where your total income, for example, it is 51 lakh rupees, and the basic tax liability, of course, on this 51 lakh rupees, we will compute the basic tax liability under optional tax regime. If we compute, it will come to 1342,500. Now 51 lakh income means I need to add now surcharge. Here my income was less than or equal to 50 lakhs only, so I did not add surcharge. But here, since my income already exceeded 50 lakh rupees, I am now required to add surcharge, and that is why here you see 10% surcharge is added on the basic tax liability. I told you, never apply this 10% on 51 lakhs. You will get Sunyam in examination. Always apply on the basic tax liability. So 10% if it is added, the total tax liability will become 14 lakh 76,750. Now is the twist. Your income increased only by 1 lakh here. From 50 lakhs, we increased the income by only 1 lakh. But look at the tax. The tax increased by how much? 1 lakh 64,250. You only genuinely think, if for an increase of income of 1 lakh, if someone asks you tax of 1 lakh 64,250, your blood will boil like anything. That is why marginal relief benefit is given by the income tax department. So increase in tax is how much? From 1,476,750, if you remove 13,12,500, you will get 1,64,250. This is the increase in tax. Whereas increase in income is only 1 lakh. So the difference of this will be given as marginal relief, guys. Next, rebate concept. Guys, rebate is given generally as a benefit from the income tax department side to the general public of India. It is not for outsiders. So rebate will be applicable only in the case of resident, that too only for individuals. It is not even applicable for HAF, AOP, BY, AJP, guys. Rebate is available under section 87A, guys. Before cess only, you always compute rebate, then only go and take the then only go and add a health and education cess. Now rebate for resident individuals, section 87A, guys. Here also two regimes: default tax regime, optional tax regime. Now guys, keep in mind one thing. Under default tax regime, the rebate limit is given 7 lakhs. 7 lakhs is the total income limit, not gross total income. Total income is different, gross total income is different. Gross total income is just the sum of all the 5 heads of income. But after that, when you take off the chapter 6A deductions, if you reduce that, whatever you receive is the total income, guys. So that total income, if it is up to 7 lakh rupees, sir, what if it is exactly 7 lakh rupees? Still you enjoy this benefit of 7 lakhs. If you have, in that case, you have to compare two things: 25,000 or 100% of your tax liability. Whichever is lower will become your rebate. Means out of your 7, whatever your total income is there, which is up to 7 lakhs, on that you compute your total tax liability and you compare with the 25,000 rupees. Whichever is lower, you can reduce from your tax liability. The net amount only you are required to pay to the income tax department. Now under optional tax regime, the limit is 5 lakhs, and you will compare not 25,000, you will compare 12,500 with your 100% of tax liability, guys. Now rebate is not available against income under section 112A. Keep this in mind, guys. 112A is long-term capital gain tax on 3 kinds of listed units or equity shares, guys. Only on these 3, guys, 112A income is not eligible for rebate. Now marginal relief on rebate, guys. You know what? Under default tax regime, government is saying that I will give you not just marginal relief for surcharge. I will give you marginal relief for rebate also. This applies only under default tax regime, guys. This concept does not apply for optional tax regime. Mind you, only for default tax regime. With example, I will teach you this. Guys, if your total income is 7 lakhs, for example, your total income is 7 lakhs, for example, mind you, you are under default tax regime, so you will compute basic tax, which will come to 20,000 rupees. Now under 20,000 rupees means already your income, total income is only 7 lakh rupees. I told you already just now, under 87A, wait a second, under 87A, if your total income is 7 lakhs, in that case you will get a rebate up to the extent of 100% of tax payable to the maximum of 25,000. Now here your total income is 7 lakhs, means you are eligible for 87A rebate, correct? So 20,000 was your basic tax liability, but you are enjoying 87A benefit of 20,000, so your tax liability is becoming sunyam here, correct. Now I will take one more scenario where I'll increase my income little bit from 7 lakhs. If I increase my income to 7 lakh 15,000, for example, do you think I will enjoy my rebate benefit now? No, absolutely no. I will not enjoy my rebate benefit here, because my income already exceeded 7 lakh rupees and I have to pay this basic tax of 21,500. Now remember, guys, income increased only by 15,000 rupees and the income tax liability increased by 21,500 rupees. Just imagine, if your income itself increased only by 15,000, but government is asking you 21,500 rupees of tax, it will hurt you like anything. That's why government says, wait, I will give you marginal relief benefit on the rebate. So increase in tax is 21,500, increase in income is 15,000. So marginal relief on rebate will be 21,500 minus 15,000, which is 6,500 rupees. Now how will you compute the tax liability on 7 lakh 15,000 income? Simply you will take this 21,500 here and you will reduce this marginal relief on rebate. On the balance amount of 15,000 you will add health and education cess, and you will be paying the total tax liability of 15,600, guys. Now there is a concept of agriculture income. Lot of times in MCQ it is asked, guys. Agriculture income, generally keep in mind, it is exempted, generally exempted. Now what is agriculture income, sir? Exactly, rent from let out of a agriculture land is a agriculture income. Income from sale of agriculture produce. Now what is agriculture produce? You are growing tomatoes, agriculture produce, growing sugarcane, agriculture produce, growing potato, whatever you are growing out of a land, agriculture land is a agriculture produce. As it is, if you are selling it in the market, that is called agriculture income only. You are not doing any further operations to the whatever grown out of land. You have not done any operation. That is called the agriculture produce. If you sell directly in the market, whatever profit you are getting is agriculture income, and it is generally exempt. The third kind of income is rent from let out of a farmhouse, and the fourth is income from nursery. Guys, these four incomes are mentioned as agriculture income, which will be exempt. Now for this income from sale of agriculture produce, there is a Rule 7, sale of agriculture produce, which is very important. Now what does this rule say? This rule says that if you produce anything out of agriculture land like potato, tomato, sugarcane, whatever, if you sell that as it is in the raw form in the market, whatever income you will get, that is totally agriculture income. Okay, no problem. We will not ask you any tax. But after growing this tomato, potato, or sugarcane, you did some further operation which is not actually required for that product to be sold into the market. Means you optionally, you only have done that operation. You converted the potato into Lay's potato chips. You converted the tomato into ketchup, or sugarcane into sugarcane sugar you converted. In that case, guys, two kinds of income will come. Think logically, guys. First, you did agriculture activity out of land. You grown potatoes, tomato, sugarcane. That is agriculture activity. I agree. But there is one additional activity here, which is not agriculture activity. Means you converted this tomato into ketchup. That is not agriculture activity. That is a business activity. So here two kinds of income will come: agriculture income and PGBP income. If you convert or further process if you do, which is not required for the product. First, agriculture income and PGBP income, I told you how to compute, sir. Till the moment you grown the potatoes or tomatoes, that is called agricultural activity, correct? Now till that whatever expenditure you expended, you take that. Means, let's say for example, you paid for labor charges or pesticide expenditure, whatever you have, all these expenses will be for growing the potatoes, right? So that expenditure you will take, and you will reduce that expenditure from the fair market value of that produce, that potatoes which you used for chips activity. So fair market value of the potatoes you will take, reduce from that the cost of producing the potatoes, that will give you agriculture income. No need to pay any tax on that. But when it comes to the PGBP, now potato are converted to potato chips and sold in the market, sale of a final product, whatever sale price is there of the potato chips, you will take lesser whatever potatoes you used, the fair market value, and less process cost, means the cost of conversion of potato into potato chips you will take. That will give you PGBP income, and you have to pay tax on the PGBP income, guys. Now there are three kinds of products which government has given special rules to compute the agriculture income and PGBP income. Here you see we had to compute with this process for the all other agriculture produce, but only three products government only directly telling you, boss, out of this income 60% agriculture income, 40% PGBP income. Percentage is already fixed. First, number one is tea, coffee and rubber. Think logically, guys. Tea powder directly, tea out of, first of all, out of the land, tea leaves will come. You can't sell directly tea leaves out of the market. So people converted that tea leaves into tea powder. So that process is involved. So here agriculture process and business process is incurred. So that is why in case of growing and manufacturing of tea, agriculture income will be 60% and 40% will be treated as PGBP income. Keep in mind one thing, guys. Always take the 60% and 40% on the net income. When I say net income, means the sale price of this tea, whatever is there, less the cost of growing of these tea, whatever is there, the net income, whatever is there, on that you will compute this 60% and 40%, not on the gross sale value. Never do that. Yes. Next, like coffee also, if it is grown and queued only, then 75-25, or it is grown, cured, roasted and grounded, more business activity done. That's why more business income of 40%, guys. In case of rubber, if it is grown and manufactured, 65% agriculture income and 35% of PGBP income, it will be treated as a percentage of profit, not on the gross amount, guys. Now comes the partial integration concept. What is a partial integration? Very simple, guys. If you have agriculture income also, and if you are individual HUF, AOP, BY, AJP, and you have agriculture income more than 5,000 rupees, and your non-agriculture income also you have, which is more than basic exemption limit, three conditions has to be met. Number one, you are individual HUF, AOP, BY or AJP, and your agriculture income is more than 5,000 rupees. Your non-agriculture income is more than basic exemption limit. In that case, you will apply this partial integration concept. The name itself says partial integration, means integrate the agriculture income with the non-agriculture income just to compute the tax liability. There are 4 steps involved in this, guys. Number one, tax before cess. Before adding cess, you will compute tax on two things. Number one, you take non-agriculture income, means other than agriculture income, whatever rental income, business income, whatever you have, you take that non-agriculture income. To that you will add the net agriculture, not gross, net agriculture income you will add. So you will add these two. On that you compute generally as per slab rate the tax liability. In step 2, you will take the basic exemption limit and the net agriculture income, add both of that and calculate tax on that. In step 3, you reduce the step 1 minus step 2, you will get the basic tax liability, and in step 4 you add your cess, you will get the total tax liability ultimately, guys. That's end our discussion on the basic concepts. Now let's move on to one of the favorite topics of examiner, which is residential status. Pakka, guys. Last 5 attempts question papers you pick, 5 attempts you pick and check. Question number 2A, 100%. This attempt also I can say 6 marks from residential status they will ask. Now in case of individual and HUF, residential status is actually categorized into 3 categories, guys. Resident ordinary, resident not ordinary, and non-resident. Resident ordinary, resident not ordinary, and non-resident. Mind you, only in case of individual and HUF it has been categorized, guys. Now how to find out, sir, whether a person is a resident or a non-resident? First of all, guys, residential status of individual. Whatever I am going to discuss here is only from the standpoint of individual persons only, guys. There are 2 kinds of conditions given here, basic condition and additional condition. Basic condition, there are two conditions given. Additional conditions also, there are two conditions given. But the twist is, basic condition, any one you have to satisfy. Additional condition, both you have to satisfy. Now, if you satisfy any one of these basic condition, you become a resident. First of all, you will check whether you are a resident or not. Then only you will go and check whether you are ordinary resident or not ordinary resident. Are you getting it? So first step is whether you are resident or non-resident. That's all. First step. Once you think that, okay, you found out that you are a resident, go further and check whether you are ordinary resident or not ordinary resident. How to find whether I am a resident or not, sir? Very simple. Satisfy any one of the basic condition. And once you satisfy any one of the basic condition, then go and further check additional conditions. So on satisfying any one of the basic conditions, you will become resident. On satisfying both the additional conditions, you will become ordinary resident. Are you getting it? So what is the condition given? The basic condition 1 says, if you stay in the year in which you earn income for 182 days or more in the previous year, in that case you are satisfying the basic condition number 1. Say for example, you satisfied. Do you go and check the second basic condition? No need. Why? Only one if you satisfy enough? No. Then why to break your head on the second basic condition? No, none needed. But for example, you did not satisfy this first basic condition, then go and check the second basic condition. The second basic condition says that in the current year in which you earn income, if you have to minimum stay 60 days or more, and the last 4 preceding previous years, all 4 years put together, if you have stayed 365 days or more, you are satisfying the second basic condition. The first basic condition told what? In the year in which you earn income, stay in India for minimum 182 days or more, enough. Second basic condition says we will not check just this current year, we will also check the previous 4 years also. So in the current year minimum you stay 60 days, and the last 4 years, all 4 years put together 365 days or more if you have stayed, you are satisfying the second basic condition. And if you satisfy anyone, you will become resident straight away. But the story don't end there in the case of individual. In the case of individual, you will not just check resident, you will go and also check ordinary resident or not ordinary resident. In order to become an ordinary resident, you have to satisfy both the additional conditions. If you do not satisfy both the additional condition, you are a resident but not ordinary resident. Yes. So what is the additional condition? It says that 2 out of last 10, you always check in additional conditions, the past you check. So in the past, out of 10 past years, if you have become a resident at least for 2 years, you are satisfying first additional condition. And in the last 7 years, if you have stayed in India for 730 days or more, in that case, you are also satisfying the second additional condition. And you become resident, ordinary resident. In simple terms, here it is written, guys. Very beautifully I have given this. Basic condition means basic condition. Any one you satisfied, I told you, you become resident. Correct. Next. Basic condition, not even one satisfied, both unsatisfied, means you did not satisfy any of this, then you automatically become what? Non-resident. Correct. Next. Once you become a resident, you go further and check a ordinary resident or not ordinary resident. Mind you guys, if you become non-resident here, you never check additional conditions. Why to check? Are you getting it? So you will check additional conditions only if you will satisfy any one of the basic condition. So additional condition, any one only satisfied. I told you here, both has to be satisfied, but you satisfied only one. You did not satisfy the second one, then you become resident but not ordinary resident. Additional condition, both satisfied, then you become resident and ordinary resident. Mind you guys, in examination, when the dates are given, always keep in mind both the date of departure and date of arrival to be treated in India only. Means the day you boarded the flight, the day you landed into India, both are considered to be in India only for calculation of number of days, guys. Next, special cases. There are some special cases, guys. Very important special cases, guys. 4 people you keep in mind. 2 persons are going out of India, 2 persons are coming in India, guys. 2 persons going out of India is the person being an Indian citizen leaving India for the purpose of employment or as a member of a crew of a ship. So these 2 persons are leaving India. Next, another two persons are there who are coming in India, guys. Indian citizen or person of Indian origin visiting India and having income tax in other than foreign income sources of 15 lakh rupees up to, guys. Now keep in mind one thing, guys. Indian citizen or person of Indian origin, generally they are living outside India. They are Indian citizen or person of Indian origin who is visiting India. So two people going out, two people coming in. These four people are covered under this special case one. Now in this special case, what you will do, you delete the second basic condition which we have. What is the second basic condition we have? You just delete the second basic condition. Means in these four people's case, in the special case scenario one, only first basic condition it will applicable. So if you satisfy 182 days or more, you are a resident. If you do not satisfy 182 days or more, straight away you are a non-resident. So what if I satisfy 182 days or more, sir? Then go and check the additional conditions. Yes. Now see here, basic condition only one. 182 days or more during previous year, delete the second basic condition. Additional condition, both you need to satisfy. Next, special case 2. Now in special case 2, whoever person went out of India, who left for India, will not be applicable or will not be covered here. Only those two persons who are visiting India will be covered here. Indian citizen or person of Indian origin visiting India during the previous year and having Indian taxable income more than 15 lakh rupees during the previous year are only covered here. So you will check the total income also in this case, guys. Mind you, only Indian taxable income you will consider, not the foreign sources income, guys. So Indian taxable income you will consider more than 15 lakh rupees if it is during the previous year in this two persons case. In that case, guys, basic condition number 1 remains the same, but in the second basic condition where we have here 60 days, you delete this 60 and replace it with 120 days, guys. You will replace it with 120 days and rest remains the same, guys. So 182 days or more, basic condition 1 applies, and in the place of 60 you take 120 and 365 in the last 4 years also applicable. And then of course these two important points you need to keep in mind. If satisfies first basic condition, then check both additional conditions, of course. So if this person satisfies this first basic condition, go and check additional conditions, no problem. If it does not satisfy the first basic condition, means this person is not living in India for 182 days or more during the previous year, of course you have the other option, no second basic condition, you will go and check. Now, see here, if it does not satisfy first basic condition but satisfies the second basic condition, no need to check additional condition. Person is straight away resident, not ordinary resident only, guys. Next, scope of total income, very important, guys. In residential status, either they'll ask you the residential status in special category, or they'll also mix, because it is a 6-mark question, they will also mix the total income computation also in this residential status only. Mind you, foreign income and all they'll give you, you need to find out which is Indian income, what is a foreign income. First of all, guys, keep in mind 2 dialogues, very simple dialogues you keep in mind. Then third dialogue I will teach you, guys. If you are a resident, ordinary resident, means you are a purely 100% Indian breed. You are resident ordinary resident means you are living in India only. You are a resident ordinary resident. In that case, you have Indian income, foreign income, whatever income you have, it is all taxable, guys. It is all taxable. No need to even check anything, guys. If you are a resident and ordinary resident, means you are a pure resident person, every income is taxed. But if you are a non-resident, guys, only Indian income is taxed. Only Indian income is taxed, guys. Only Indian income is taxed, not the foreign income. So if you have any kind of foreign connection in non-resident case, guys, don't tax anything. Only Indian income will be taxable. Very simple. Now comes the resident not ordinary resident case. Resident not ordinary case, just remember my dialogue. Indian income, every Indian income, it is taxed. But in foreign income, if 2 kinds of PGBP income you have, that will also be taxed in the hands of RNR in India. What are the 2 things, sir? If you have a business controlled from here in India, or if you have a profession which is set up in India and you are earning any income from outside India, these two incomes will be taxed in the hands of resident, not ordinary resident in India. I repeat, you have a business which is set up in India and you are earning any income outside India, or you have a profession, if you have a business which is controlled from India and you are earning any foreign income, and you have a profession set up in India, due to this profession, through this profession you are earning any foreign income, these two incomes will be taxed in the hands of RNR. Though it is a foreign income, though he is a resident, not ordinary resident, it will be taxed. All other Indian income, though obviously it will be taxed, but a foreign income, when it comes to, only two kinds of income will be taxed: the business controlled from India and you are earning any foreign income, or profession set up in India and you are earning any foreign income, that will be taxed. All other foreign incomes you need not tax in the case of resident, not ordinary resident, guys. Now keep in mind, this is beautiful summary table, guys. It will tell you what is the Indian income and foreign income, beautifully I have given, guys, because you need to understand now whether the income is Indian income or foreign income. Then only you will be able to decide whether you need to tax this income or not. Now in total income, there are two kinds of income, guys: Indian income and foreign income. How to know, sir, whether income is an Indian income or foreign income? Very simple, guys. Two categories you need to keep in mind: where the income accrued and where the income received. Accrued means what? The place of generation of income. Received means what? Where did you receive the amount? In which bank account you received? Where did you receive the cash? That is called as income received. But accrued means what? Where the services are performed, there the income gets accrued. So these, based on these two categories, we will decide whether the income is an Indian income or a foreign income, guys. Mind you, guys, if anyone, guys, simple logic I'll tell you, if accrual or receipt, any one is in India, straight away it is Indian income, guys. If both accrual and receipt outside India, means straight away you keep it as a foreign income only. Mind you. There are certain incomes which are deemed to accrue or arise in India. Those incomes don't please consider here. I am telling there are certain incomes which will be deemed to accrued or arised in India, or deemed to be received in India. In that case, they are deemed. Don't apply this logic to those incomes, especially in case of a person who is deployed by Indian government outside India in Indian foreign services. Salary given by central government to that person will be deemed as received in India only. Though it is services are rendered outside India, though income is received outside India, still that income will be treated as Indian income only, because that is a deeming income. But generally, how do you find Indian income or foreign income? Based on this you will find, guys. First, accrued or receipt. Simple, I told you, no, either accrual or receipt, any one in India, it is an Indian income. If both accrual and receipt both are outside India, it is a foreign income. With this logic, guys, accrued in India means straight away Indian income, received in foreign, still Indian income. Accrued in foreign, received in India, anyone happened in India, so Indian income. Accrued in foreign, received also foreign, so foreign income. Accrued in India, received in India, Indian income. Simple. Next, deemed resident, guys. Lot of times in examination this has been asked. There are some conditions which you need to keep in mind, guys. Deemed income is generally applicable, or we compute, or we calculate, or we find out, or we determine only in the case where a person is not residing in India, but he is an Indian citizen living abroad, for example in Dubai, where there is no tax liability. You know, in Dubai there is no individual taxation. Means of individual, whatever income he will earn, there is absolutely zero tax on that. Now he is an Indian citizen living abroad. Correct. So only in that kind of person's case only you will apply the deemed resident concept, guys. Indian citizen having Indian sourced income more than 15 lakh rupees. Means here first condition is you have to be Indian citizen. Number two, second condition is you have Indian sourced income more than 15 lakh rupees. Sir, what if I am an Indian citizen having income of only 10 lakh, sir? Then in that case don't apply this. Deemed resident concept will not be applicable to you. Will be deemed as resident if he is not liable to tax in any other country. So he should not be also liable to tax in there are some tax haven countries, right? In that country, if he is there due to domicile or any kind of a reason, he is not paying any tax outside India also, he is not paying tax in India also, but he is an Indian citizen having income of more than 15 lakh rupees. In that case, guys, you have to always treat this person as deemed resident, guys. So what are the conditions? Indian citizen having income, Indian sourced income of more than 15 lakhs, and he is not liable to, if you see in the question, the language not liable to tax in the country, guys, deemed resident concept should click in your mind, guys. And always keep in mind, for a deemed resident, guys, we do not compute whether he is a resident or non-resident, whatever. He is always a straight away a resident, not ordinary resident. This wraps up our basic concepts and residential status. Now let's move on to the next topic, which is salaries, guys. Every attempt, minimum 4 marks are asked from salary topic. Now, guys, the salary has a lot of components: basic salary, dearness allowance, commission, bonus, advance salary, gratuity, pension, everything are put together called as a salary. So you compute first the gross salary. From that you are eligible for some deductions. Mind you, these deductions are not eligible under both the tax regime. There are some provisions attached to that. We will be discussing that also. Profession tax we can take as a deduction, entertainment allowance and standard deduction also we can take, and then we will arrive at net salary, which will be going and forming part of your gross total income, guys. Keep in mind one thing, guys. Commission, there are actually two kinds of commission. One is a fixed based on the fixed commission. The other is turnover based commission, guys. If in the question percentage turnover is given or a fixed amount, fixed commission means commission 25,000, commission 20,000. This is fixed commission. Commission as a percentage means they'll give in the question commission 5% of turnover. That is called turnover based commission, guys. Now, there is a concept called as a dearness allowance. These are the basics in salary, guys. Very, very important. Dearness allowance, there are two kinds of dearness allowance, guys. Dearness allowance in terms, dearness allowance not in terms. Very, very important, because at lot of places for retirement benefits like pension, gratuity, all these places, if you have to compute the exemption, there are salary definition. Sometimes it takes a DA in both. DA in terms, DA not in terms. In that case, you need to understand DA in terms means sometimes in the language of the question, it will not tell DA in terms. They will tell DA forming part of retirement benefits. In that case, it means that forming part of retirement benefit means DA in terms. If the question says DA not forming part of retirement benefits, it means a DA is not in terms. And DA both means full DA. You have to take both not in terms and in terms, guys. Next, allowances. First, you need to understand house rent allowance. Lot of times in MCQ it is asked. Mind you, guys, house rent allowance will get exemption. Your employer gave you some house rent allowance. Let's say, for example, 1 lakh rupee he has given you. Total 1 lakh will not be taxed in your hand. Don't worry. If you are paying tax under the optional tax regime, you can enjoy the benefit of exemption, which you have to compute. Out of 1 lakh, total 1 lakh not exempt. Little bit is exempt, which you have to compute. How to compute, sir? Like this you will compute. But mind you, exemption is given out of house rent allowance only under the optional tax regime only, guys. House rent allowance is a special allowance given, guys. How to compute, that will depend on where you are working, where your employment is situated. If see, house rent allowance exemption under optional tax regime only, least of the following is exempt. So how much are exempt? It will depend on where your employment is or where you rented the house. If you have rented the house in a metro city, in that case, metro city means don't think that Hyderabad is also a metro city. Wherever metro is there, that is a metro city. No, not like that. Only these 4 cities are a metro cities, guys. In examination, be very, very careful. Only these 4 cities are metro cities. Apart from that, whatever cities there is a non-metro city, and you apply this concept. In case of metro city, you apply these 3 things. Whichever is lower, least of the following will be eligible for exemption from total actual HRA, whatever you receive from your employer. Reduce this whichever is lower here, and you will get the taxable HRA, which will go and form part of your total salary income. First, you will take HRA actually received for relevant period. Here means relevant period means the period for which you have rented the property, guys. Rent paid minus 10% of salary for relevant period, 50% of salary you will take. Only difference here and here is what you know. Here for metro cities it is 50%, other cities it is 40%, guys. Now for salary, wherever here it is saying 10% of salary, 10% of salary, 40% of salary, 50% of salary, what should I take, sir? For salary, this is the definition, guys. Basic salary, DA in terms, and commission as a turnover. Sir, what What if in the question commission fixed is given sir? Don't take that, because exactly you have to take what is given in the formula. So in salary you will take only basic salary, DA in terms only you will take. You will not take the DA both or DA not in terms, and you will take fixed as a percentage only if it is given in the question you take. If a fixed commission is given, don't consider, guys. Next, there are some other allowances, guys, like children education allowance, extent to which allowance is exempt. You might have got 1000 rupees from your employer, but out of that 100 per month per child it is exempt. Up to maximum of 2 children it will be exempt, guys. And allowances to meet hostel expenditure of the child of employee, in that case 300 per month per child up to 2 child. And tribal area, if you are deployed in tribal area, whatever allowance you received from your employer, from that 200 rupees per month will be exempt, guys. Now coming to retirement benefits, lot of times employer will give you pension, gratuity, all that will generally be taxed in your hands in the form of salary, but government is also giving you some exemptions out of it, so you can take or deduct the exemption part, and net only you can pay tax. But keep in mind one thing, guys, in pension there are two kinds of pension: commuted pension, uncommuted pension. Commuted pension means lump sum. Lump sum means a bulk amount you are taking in the form of pension. Pension, when do you get? Generally you are required to actually get pension at the time of retirement. Correct? Now uncommuted pension means you are not taking a lump sum, you are monthly you are taking, or quarterly you are taking. That is called pension received periodically, like monthly or annually. That is called the uncommuted pension. In pension you will keep in mind one thing, guys. One second. In pension, you keep in mind one thing, guys. If it is a commuted pension, means you are taking lump sum, you are taking. In that case, you are a government employee, it is fully exempt. Or let's say for example, first we'll start with uncommuted pension, means you are taking monthly or annually, fully taxable, guys. Whether you are a government employee or non-government employee, does not matter. If you are taking it in installments, it is straight away taxable in your hand, be it any kind of employee. But you are taking a lump sum, commuted pension you are taking at the time of retirement, in that is government employees fully exempt. If you are other than a government employee, in that case, you need to check one point. Did you receive gratuity also from your employer? If you had received gratuity also, in that case, exemption will be total pension into 1/3. If you did not receive gratuity, you only received pension, you did not receive any gratuity from your employer, your exemption will be half of the total pension. Now, 2 points you will keep in mind, guys. 2 points keep in mind, guys. Okay, number 1, total pension means what? Total pension means not the commuted pension. Total pension means the commuted plus uncommuted pension, guys. Commuted pension, total pension means commuted plus uncommuted pension. On that you will calculate 1/2 or 1/3. Sir, very confusing. No sir, 1/3, 1/2. How to remember or recall in examination? Very simple, guys. You received gratuity also, means you received some additional benefit also. In that case, exemption will be given little bit less. See, 1/3 means 33.33%, whereas 1/2 means 50%. Correct? Now, 50% is more exemption, or 33.33 is more exemption? 50% is more exemption. But you are getting more exemption only when you did not receive gratuity. If you did not receive gratuity, only then more exemption is given to you. If you received gratuity, less exemption is given, which is only 33.33%. Now coming to gratuity. If you receive gratuity, guys, during employment and at the time of retirement or death, there are two concepts. If you received gratuity at the time of employment itself, you are in a full hurry, you did not wait, you did not have patience to wait till the retirement, then of course go and pay tax. Whether you are a government employee, private employee, does not matter. You did not wait till retirement, so received during employment itself, you received gratuity, fully taxable in case of any employee. But you waited till the death or till the retirement. In that case, government saw that okay, he has waited for some time, so let's give him some exemption. If you are a government employee, fully exempt for you. If you are other than a government employee, guys, in that case, you will check whether you are covered under Provision of Gratuity Act or not. If you are a POGA employee, means you are covered under Provision of Gratuity Act. You are a non-POGA, means you are not covered under a Provision of Gratuity Act. If you are a POGA employee, least of these following will be exempt. Mind you, actual gratuity you will receive from employer. Out of that little bit exemption is given. How to compute that exemptions? Simple, least of these following will be exempt based on whether you are a POGA employee or a non-POGA employee. Under POGA employee, you will check 15 by 26 into salary per month into number of years of completion of service. Always keep in mind one thing, rounding off is allowed under POGA employee. Non-POGA employee, rounding off is not allowed, and maximum here is 20 lakhs. Now, sir, what is the salary definition, sir? Here, salary per month is given. No. Here you see average salary per month is given. What is the salary definition? So salary definition is this, guys. Here salary means lost grant salary plus DA, both you will take. And non-POGA employee, in that case, average salary means simple, guys. Last 10 months average salary. Don't include this current month salary in which you got retired. Last 10 months salary you take. And you will take a DA in terms here and a turnover commission and basic salary of last 10 months. You will take the average. Average means what? Last 10 months salary you take divided by 10. That is average, guys. Now, when I told you here rounding off allowed and not allowed, see here rounding off allowed, here rounding off not allowed. What do you mean by rounding off, sir? If your completion of service is 25 years and 6 months, exact 6 months is also 25 years only. You have to exceed 6 months. In that case, you will get one extra year. 25 years and 7 months you served, then 26 years it will be considered. 25 years 3 months only, which is less than 6 months, 25 years only it is considered. And here rounding off anyway not allowed. So 25 years 6 months 25, 25 7 months 25, and 25 3 months also 25 only. Then comes the leave salary, guys. Leave salary or leave encashment. If you received same during employment only, you did not wait. During employment only you took, fully taxable whether you are a government employee or a non-government employee. But you waited and received it on the time of retirement. In the case of that, government employee fully exempt. And in case of other employees, you have to take least of the following: average actual leave salary received 10 months into average salary per month, leave credit into average salary per month, maximum 25 lakhs, whichever is lower, you will claim it as exemption from the actual leave encashment which you received from your employer. You will keep in mind 2 points here. Leave credit, always it should be in months only, guys. So let's say for example in the question it is given 240, 120 is the total leave eligibility. You claimed 90 already leave availed. So 30 is there, no, 30 days of leave is there. That 30 you will convert into 1 month, because here in months you will take a leave allowed minus leave taken, already 120 minus 90, maximum 30 days for each completed year you will take, and that will be converted into month, guys. So how to compute average salary? Same like we did in the case of gratuity, you will compute. Now comes the perquisites, guys. Perquisite is kind of a benefit in the form of a kind. A house is given, a car is given, driver is given. Like this, some benefit in kind is given by the employer to you, guys. It can be monetary also. Monetary in the sense monetary or non-monetary, any kind of benefit given by the employer, guys. First is rent-free accommodation, guys. House accommodation is given by the employer. In that case, whatever value you are getting, how much value you are getting, out of that how much exemption is given, here it is given in the case of perquisite. So whatever house you have got, out of that how much has to be taxed is given here. Accommodation provided to government employee. If you are a government employer, if government has given you the accommodation, in that case license fee you will take first, determined by the government. This will be given in the examination in the question paper, don't worry. Less rent actually paid by the employee. Perquisite value you will get for unfurnished accommodation. Guys, mind you, if a furniture is also given, first you find out the perquisite for the unfurnished accommodation all the time, then you add the furniture value to that. So first government license fee you take, less rent actually paid by the employee. Guys, in all perquisites, one dialogue you keep in mind: if anything is collected from the employee by the employer, that has to be reduced from the perquisite value, correct? Because the benefit derived from employer less benefit collected from employee, net only will be taxed as the perquisite. No. So wherever you see rent actually paid by employee or whatever you have paid being an employee, that has to be reduced. So first unfurnished accommodation, to that you will add furniture value. How to add furniture value, sir? First you take perquisite value as per the unfurnished accommodation. To that you will add, you have to check whether the furniture is owned by the employer, means the government, or whether the furniture is rented by the government. It can be any case. So if it is owned by the government, you take 10% of the cost of furniture. If the furniture is hired by the government itself and then given to you, then whatever higher charges paid by the government will be benefit for you, no less any charges collected from you. That total will become furnished accommodation. In the case of government employee only, you will apply license fee concept here. Let's say, for example, it is a non-government employer or employee, non-government cases, private. In that case, accommodation owned by employer. Possibility is there? Yes. So in that case, it depends on the population. If the population where you have been given the accommodation is in this category, you will take the perquisite value like this. Of course, 5%, 7.5 or 10%. Here also the salary definition is different. In the case of accommodation taken on lease by the employer and then given to you, then lower of these two you will take. Actual rent paid by the employer and 10% of salary, rent collected from you actually have to be reduced. In case of furnished accommodation, I already told you, first perquisite value of unfurnished accommodation you take, to that add the furniture value. There are two possibilities: furniture owned by the employer, or furniture itself is rented by employer and then given to you. If it is owned by employer, take 10% of the cost of furniture. If it is hired by the employer, think logically. No, think logically. If it is owned by employer, you take the 10% of the cost of furniture. If it is hired by employer, what is paying rental on behalf of you, that you take higher charges paid by employer, less anything collected from you, that will give you the perquisite value. If accommodation is not given in a home, they are giving in your hotel. Sometimes the employer is telling you, you stay in this hotel and then come for a job. In that case, guys, if accommodation is provided in a hotel, in that case you will have to compute, you have to compare two things: 20% of 24% of salary and actual charges paid by the employer to the hotel person. Whichever is lower you will take, unless anything collected from you, that will become hotel accommodation perquisite value. Next comes the interest free or concessional loan. Lot of times employer may give interest free loan to the employee, or a concessional rate they will give. So generally, let's say for example, employer gave 10 lakhs of loan to you without any interest, guys, without any interest. So there is a benefit to you because he did not collect interest, correct? So that kind of a scenario is also perquisite only. So the benefit means the interest which is foregone by the employer will be treated as perquisite in the hands of employee. So loan amount should be more than 20,000 rupees, and perquisite value will be interest rate charged by SBI, lesser rate charged by employer. So government income tax department generally compare the interest rate as per the SBI. So SBI, let's say for example, State Bank of India is giving loan to outsiders for 10%. Your employer gave the loan to you for only 4%. Then 6% benefit is there. That benefit is a perquisite in your hand. Let's say for example, employer did not collect any interest from you. Then State Bank of India is given a 10% no. So that 10% will be benefit in your hands. Next. Gift from employer to employee, very very important. Gift in cash, fully taxable. In cash, if you are receiving anything, fully taxable. In kind means some car or something is given to you. Fair market value of the gift, if it is less than 5,000, then exempt. If it is beyond that, fully taxable, guys. Use of movable assets means employer is giving you some movable asset to use, like furniture or something like that. In that case, if any movable asset is given to you for usage by the employer, in that case, use of laptop and computer, though it is movable, nothing is taxed in your hands, no perquisite there. But apart from laptop or computer, if any other asset like TV, bike, anything is given, asset is owned by employer. Again, logic, guys, keep logic. 10% of cost less anything collected from you. If that asset itself is hired by employer and the employer itself is paying some rental charges for that furniture or TV or whatever, then rent paid by employer less anything collected from you. Next, transfer of movable assets. Earlier this was use, only for use purpose they have given you the asset, movable asset. But here what is happening? Transfer means he is giving away the movable asset to you. The employer is giving it to you. So if a computer and electronic items is given by the employer, then value of perquisite will be depreciated value of asset, means the WDV. Then depreciate at the rate of 50%. You will have to depreciate at the rate of 50%, and the depreciated value will be treated as a perquisite in your hands. If motor car is transferred to you, in that case, depreciated value will be perquisite. Sir, how to depreciate, sir? Take the rate of 20% on WDV basis, and any other asset, if it is given to you, take the depreciation at the rate of 10% based on SLM method, guys. Okay, next. Lot of times employee stock options are given. Let's say for example, Reliance Ambani has a Reliance company which is a listed company share. Now that the shares are given to its employees at a cheap price. Actually the share price is 1,000, but Ambani gave for 400 rupees only to its employees Reliance shares. Then 600 is the benefit in the hands of employee, correct? So that is what is given. Fair market value of share minus issue price will be treated as perquisite in the hands of the benefit is nothing but the perquisite in the hands of a employee. Next, medical facilities. Lot of times employer will give medical facility to the employee. Lot of times this is asked in the examination in the case of MCQ, guys. Keep in mind, beautiful point it is. Total, the following medical facilities are exempt from tax. So apart from this, whatever is given is taxable. These are exemptions, exempted medical facility. Number one, medical treatment in hospital maintained by employer. Let's say for example, Ambani has his own hospital. Yes, in Bombay. So in that, employee is taking any treatment for free. That is not taxable, even though it is taken for free by the employee, because the hospital itself is owned by employer. Reimbursement of expenditure actually incurred. Now, reimbursement means what? Employee went to some other hospital to take treatment. Their employee first paid the amount, then took that bill and came to employer, and employer is telling, the employee is telling to employer, sir, I paid so much in the hospital, give me money. That is called reimbursement. Now, in any government hospital, if that employee went, so employee went to government hospital to take treatment, in that case, fully exempt. Whatever amount he will take from the employer will be exempt. But if you take treatment in private hospital, if the employee went to private hospital and took treatment and coming to employer for reimbursement, and employer reimbursed that amount will be taxed in the hands of a employee. For prescribed disease, if you take in a private hospital, let's say for example, for some diseases in government hospitals, there are no treatment, then of course he has to go private hospital only. No. So only in case of prescribed diseases, if the employee takes the the treatment in a private hospital, in that case it is exempt. And COVID-19 treatment also you take anywhere, it is exempt. Premium paid on health insurance of employee. So employer is taking a health insurance policy for employees only. In that case also, whatever premium paid by the employer on behalf of employee for health benefit is also exempt. Reimbursement of premium of employee or family approved under the central government scheme, everything is exempt. Amount paid by employer towards expenditure incurred outside India. Sometimes, let's say for example, especially in the case of cancer, the treatment is not available in India. You have to go abroad for treatment. In that case, if you went abroad for taking the treatment, in that case also exemption will be given if employer sponsored your medical treatment for abroad. Let's see, medical treatment of employee or even a family member also, travel abroad and stay abroad. Travel, you are going in flight, then you are staying in hotel, that and all is exempt. Travel and stay abroad of one attendant also, patient to one attendant, both exempt, but there are conditions. Exemption only to the extent approved by RBI. So RBI, let's say for example, your employer spent totally 10 lakh rupees on your abroad treatment, travel, stay, attendant, everything. 10 lakhs he spent. So you got 10 lakhs benefit from your employer per visit, but RBI told I will only approve 2 lakhs. So 8 lakhs will be taxed in your hands. 2 lakhs is exempt. Travel expense of patient and attendant exempt only if gross total income is up to 2 lakhs. Means if you are an employee whose gross total income is more than 2 lakh rupees, you will not get all these exemption of going abroad. Are you getting it? So your total income should be less than 2 lakhs only. Gross total income only if gross total income of the employee is up to 2 lakhs only. In that case, exemption is available. Family means you can see this. And for personal accident also some insurance is given. That is also treated as an exemption. Now, deductions from salary. Whatever we computed now are forming part of the gross salary. From that gross salary, you will reduce the deductions. Mind you, these deductions are very, very important, guys. Standard deduction, default tax regime, optional tax regime. If you are paying tax under the default tax regime, lower of these two, you can claim it as standard deduction from the gross salary. Gross salary means what? Basic salary, DA, bonus, gratuity, pension, everything will add, perquisites, allowances, everything. The total is gross salary. From that, you can reduce standard deduction. Always, guys, keep in mind, lot of times salary income itself separate quotient will be given. In that, never forget to reduce this standard deduction. Lot of times students forget. Yes, default tax regime, optional tax regime. Default tax regime, lower of 75,000 of salary income, or optional tax regime, maximum 50,000 you can claim. Now comes the entertainment allowance. In that case, if you are a deduction only available in case of government employees only, this is not available in the case of private employees, guys. The amount of deduction will be lower of these three. 20% of basic salary, 5,000 actual amount received from the employer. Only these three. Mind you, in case of government employee only, it is available. Then comes the profession tax. Tax on employment, guys. It is even if you pay tax, profession tax of earlier based on payment basis, it is given, guys. Yes, there is no limit. Whatever actual payment you do, that will be given as a exemption. Okay. Now you will be having one doubt, sir. Out of this, you just now told, no, sir. Wait a second. You just now told, no, sir, out of this, under optional tax regime, under default tax regime, something will be taxed and exempted. Don't worry. At the end, in the total income, I have some conditions put there. There I will tell you in which regime entertainment allowance is given and not. The next topic is income from house property, guys. Very, very important topic, guys. Income from house property. Now, keep in mind one thing. Income from house property, guys. Income from house property, every attempt. Income from house property in MCQs, it is asked, guys. In MCQs, it is asked, and lot of times as a part of total income computation also, it is definitely asked. So it becomes very, very important. Now, income from house property, when you say house property means building and land apartment thereto. When we say land apartment thereto means there is a compound wall. Here is a building. Here some empty spaces left for car parking and all. That is called as land apartment thereto. So if a land is attached to the building, that is also let out. That rental income also you offer under income from house property only. But keep in mind one thing, if a vacant land is given on rent, always tax it under income from other sources. And only house covered, sir, because here it says only house property. No, even a commercial property shutter is given on a rent. That is also, even a commercial property, if you get any rent, that is also taxed under income from house property only. Now, keep in mind this thing, guys. Types of house property, there are two types: self-occupied property, let out property. Let out property, in the name itself is there. Let out means you have given that property on rent to someone. Self-occupied means you are using that property for your own purpose. That is called self-occupied property. Always keep in mind one thing, guys. Let out property is always taxable because it is very, very logical. No, let out means you would have got some kind of a rent. So of course it is always taxable. Self-occupied property, sometimes it will be taxed, guys. So how, sir, self-occupied property? I'm not receiving any kind of rent. We will see now. Now, if you are self-occupied property and you are using for residence purpose, in that case, and using for business purpose, you may be having one building. You are using for your own business purpose, right? You are not residing. Your family is not residing there. You are using for some shop or office purpose. Then simply ignore, guys. You don't consider anything under house property. But if you have a self-occupied property building for residence purpose, you are living in it. In that case, guys, there are some conditions. If you have up to 2 self-occupied properties, no problem. Fully exempt, no problem. There, of course, there is no renter, so there is no point of taxation. But you are saying that you have more than 2 self-occupied properties. In that case, government has a problem. Government says that if I leave you like that, you will tell all properties are self-occupied only, you will not pay any tax. Right? So government has kept a cap on that and told that maximum 2 properties only I will treat it as self-occupied. You may be self-occupying 5 properties, but I will treat maximum 2 only self-occupied. Beyond 2, whatever self-occupied properties are there, that will be deemed as let out property only, and we will compute the annual value for that property, and you have to pay tax on the income from house property, which we will compute. So if you have more than 2 self-occupied properties, remaining means beyond 2, whatever is that deemed let out, up to 2 self-occupied properties, exempt will be given. Now, sir, can I choose, sir, whichever properties? Say for example, I have 5 properties, sir. Out of that, can I choose, sir, any 2? Yes, you can choose. Rest 3 will be treated as deemed let out property. Yes, next. How to determine the annual value? Sir, why are we saying annual value, sir, here? We should say no rental value. No, annual value means the value which is determined by the income tax department as per the section 23 of Income Tax Act. Because your rental income may be less than the annual value, in that case, we have to offer the annual value which is expected by the government. How to compute, sir? You need to first take 2 things. First, you take municipal value of the building and the fair rent. Are you getting it? So, first municipal value and fair rent, you will take whichever is higher value you will get. This whichever is higher value is there, you compare it with the standard rent. Don't worry, I'll teach you what is standard rent and all. So whichever is lower of these two, whichever is lower, that will become expected rent. The name itself says expected rent means this is minimum rent expected by the government from you. Then you compare this expected rent with the actual rent, means the actual rent which you received from your tenant. Then whichever is higher, you have to treat it as gross annual value. Sir, why do we take whichever is higher, sir? Here, think logically, guys. Government is expecting, let's say for example, 1 lakh from you. You are telling them my actual rent is 80,000. Do you think government will accept 80,000 from you? No. Government is saying, I am expecting 1 lakh. You are only offering 80,000. So whichever is higher, I will take. Are you getting the logic? So let's say for example, one more ulta I'll take. 1 lakh is the expected rent from the government. 1,20,000 is the actual rent which you are offering. Then whichever is higher is 120. Government is very much happy. No, because government expected 1 lakh. You are offering 1,20,000. What is required then? Yes, Aram says. So that is why whichever is higher, we are taking gross annual value. So from gross annual value, so gross annual value will be what? Technically speaking, your gross rent. Correct? Gross rent. If total gross rent is taxed, it is very unfair to the people of the country. So government told, I will give you some deductions from this. Number one deduction is municipal taxes. So whatever taxes you paid for the property which is let out, that property taxes you reduce from here, and the net will be taxed. From that net also I'll give further benefit. Like I'll give you some deductions under section 24. The first deduction I'll give you is standard deduction, 30% straight away on the NAV value. Guys, mind you, always calculate this 30% on NAV. Never calculate on the gross annual value, guys. Never do that mistake. Then interest deduction also you will take. Sir, what interest, sir? Interest you paid on the loan which you took for construction or purchase of the property which you have let out. And once you remove these deductions also, you will get income from house property, which will ultimately go and sit in the gross total income, guys. Yes. Now, so keep in mind these points in examination. Lot of times in examination, this municipal value, this fair rent, this standard rent, they will not give you straight away these terms. They will try to twist you and confuse you. What kind of twist? Municipal value, they will not tell directly municipal value. They will tell value determined by municipal authorities. If this line you see in examination question, you have to imagine that, okay, this is municipal value. Now, one more point I would like to say. Guys, municipal taxes here I told no. Municipal taxes, lot of times they'll not give you amount. Like let's say for example, municipal taxes 1 lakh if it is given, very easy for you. You can reduce from the GAV, no problem. But sometimes they will give you only percentage. Municipal taxes 5% and they will keep quiet. They will not tell anything further. Then you have to apply this 5% on the municipal value which is given in the question, guys. 100% municipal value will be given in the question. You always apply, if percentage is given, apply on municipal value to find the municipal taxes, guys. Be very, very careful. ICI plays lot of tricks, guys. Yes, next. Municipal taxes paid 10% if it is given 90,000 rupees. Sometimes what will happen, they will tell you municipal tax paid how much. 10% they'll give you 90,000 and this information will not be given municipal value. Then how to determine municipal value out of the municipal taxes is very simple. If you paid 10% at the rate of 10% amount of 90,000 of municipal taxes, very simple. This 90,000 represents 10% means then 100% municipal value will be 9 lakhs. Very simple mathematics. And for fair rent, lot of times the language will be used is rent of similar property in the similar locality. They will use like this dialogue. That means fair rent. Standard rent, for standard rent purpose, they will use a dialogue rent as per Rent Control Act. It means a standard rent. Yes. So these points keep in mind, guys. Yes. Next. Summary. Very, very important summary this is, guys. I told you 3 kinds of deductions you will get. Municipal taxes, standard deduction, interest on loan deduction you will get. Now keep in mind one thing. There are 2 kinds of tax regime. Correct. And there are 2 kinds of property, self-occupied property, let-out property. Always keep in mind one thing, guys. Let-out property means you are offering rental income to the income tax department. Correct? You are offering or you are paying tax on the let-out property's rental value. So everything is allowed, guys. Everything is allowed. Municipal taxes fully allowed. Standard deduction 30% allowed. Interest on loan, whether you are paying tax under optional tax regime or default tax regime, fully allowed, guys, because you are offering rent to tax purpose, correct? The problem arises only in the case of self-occupied property, guys. Keep in mind, only in the case of self-occupied property, you have to be little more cautious. Now, keep in mind one thing, guys. Self-occupied property, municipal taxes, nothing will be allowed. Sunyam. So, in case of a self-occupied property, your NAV itself will become straight away nil, guys. GAV anyway nil, because it is a self-occupied property. There is no expected rent. There is no actual rent. So, municipal taxes also not allowed. Standard deduction, of course, there will not be any standard deduction because NAV itself is nil. Where is the point of standard deduction? Then interest on loan, very, very important point. If you are paying tax under optional tax regime, only in case of optional tax regime for a self-occupied property, maximum 2 lakhs of interest deduction is given. Under default tax regime for self-occupied property, nothing you will get as interest deduction. Now keep in mind one more point. This 2 lakhs of deduction is put together both self-occupied, because I told you self-occupied property, maximum 2 properties you can treat. For both the properties put together, it is a 2 lakhs limit, not for each property, guys. Very, very important point. These also. Municipal taxes is allowed only on a payment basis, guys. Let's say, for example, municipal taxes 10,000 is payable. You paid only 8,000 paid. 2,000 unpaid, you will not get deduction of 2,000. Only 8,000 you are eligible because you made payment of 8,000 only. But interest deduction, it is not like that. Interest deduction, even if it is payable, still you will get the deduction, guys. Interest deduction is allowed on accrual basis, even if actual payment not done. Guys, this note which I am writing on the screen, trust me, guys, download this and revise. Hardly 80 pages. It will not take more than 2 hours for you to revise. But I can pakka say all the adjustments will come from this PDF only, guys. Yes, next. Next comes the pre-construction interest or pre-acquisition interest. Guys, a lot of times you take a loan for the purpose of construction or purchase. Before even the property is purchased, you pay interest. That is called pre-construction interest. So you took loan, you started construction of the property. You took 1 year or 2 years for construction. Once the construction is completed, then only your income from house property will be computed. During the construction process or period, there is no income from house property because there is no house property at all. So once the construction is completed, for whatever period before construction you paid interest now, because you will be paying interest as soon as you take loan, the interest will start. So for 2 years you constructed the property, but you paid interest also. That interest also you can claim as deduction once the property is ready. But keep in mind, pre-construction period interest you will start calculating or considering starts from the date you took loan, but ends, very, very important, ends on previous year immediately ending before the date of completion of construction. Let's say, for example, my construction got completed in this year. Now, pre-construction period interest will start from the day I took loan to this year. My construction got completed, but I will not take the pre-construction interest till date. I will not take. I will take immediately preceding previous year when it ended, 31st of March. Only till then. I will take practical example also. Don't worry. Now, once you take the pre-construction interest period interest, that will be allowed not in the first year in which construction got completed full. No, it will be allowed in 5 equal installments starting from the year in which the construction got completed. So in this year my construction got completed, whatever pre-construction interest I will calculate, that I will take divided by 5. So in 5 years it will be allowed 1, 2, 3, 4, 5. 5 years it will be allowed in 5 equal installments. Pre-construction allowed in 5 equal installments. 1/5 in each year for 5 years starting from the year in which completion got over. Now one practical example. Thalaiva took a loan of 20 lakhs from State Bank of India on 1/4/2018 for construction was completed on 30 November 2020. Now mind you guys, 18, 19, 19, 20 will be treated as pre-construction period. Sir, but 2021 is also construction happened. No sir, just now I told you only the previous year which just ended, the year which just ended before the year in which the completion got over, that is called as pre-construction. This you will not take till 30th of November. No, you will take till 31st of March 2020 only. Yes, next. So in that case, what will happen if the interest rate is 9%? Pre-construction period interest, I told you already, from 2018 to 2019, 20 means 2 years you will take. How much is the loan? 20 lakhs, 9%. 18-19 you paid 1 lakh 80. 19-20 you paid 1 lakh 80. So total pre-construction interest is 3 lakh 60,000. 150 only allowed, I told you. 3 lakh 60 by 5 will be 72,000. Now keep in mind one thing, guys. In the year in which construction got completed, two kinds of interest deduction you will take. Number one, pre-construction interest 1/5 installment you are taking, but in the year in which you are calculating the income from house property, this year also you paid interest, right? So actual interest, current year interest also will come here, which is 1,20,000, guys. So current year interest plus add 1/5 of the pre-construction interest. Total interest you will claim in the first year in which you construction got over. Even in the next second year also, what you will get, two kinds of interest: pre-construction interest 1/5 installment and that year's current year interest, like that you will get. Now there are some special cases in income from house property, very important, guys. Keep in mind concept of vacancy. Sometimes in the question it will be given that property was vacant for 3 months. So out of a total 12 months, let's say for example 9 months you let out the property, 3 months the property was vacant, guys. Mind you, guys, don't please confuse a vacancy with a self-occupation. Please don't confuse. Vacancy is what? You intended to give the property on rent to someone. You did not find the tenant. That is called vacancy. Self-occupation means what? You, after the tenant vacated after 9 months, you self-occupied it. That is not a vacancy, guys. That is not a vacancy. Your intention was there to give the property to someone, but tenant you did not find for 3 months. That is called vacancy. Only in that case, guys, apply this concept which I am teaching you now. Case of vacancy. GAV in case of vacancy, how to compute, sir? Guys, keep in mind one thing. GAV is what? Expected rent or actual rent, whichever is higher. But think logically. Out of 12 months, I just now told you, 9 months you gave the property on rent. 3 months the property was vacant, let out for 9 months. Now, guys, and the expected rent, whichever you will compare, municipal value, fair and standard rent, that you will come for 12 months. Correct, for full year. But here you see, you gave the property only for 9 months here, let out. You can't compare 12 months of expected rent with 9 months of actual rent. No, unfair will happen. That is why, guys, in case of vacancy, when you have to compute the GAV, expected rent or actual rent, whichever is higher, you will take expected rent for 12 months. Actual rent means the 9 months actual rent. How can you take actual rent about 12 months? There is no actual rent for 12 months. Actual rent is only for the let out period, 9 months. So you will add vacancy rent for 3 months, because you have to compare 12 months with the 9 months plus 3, that will become 12. Then only fair comparison will happen. That is why, guys, only in case of vacancy you do this. Don't do in any other concept. Only in case of vacancy, compare your expected rent of 12 months with actual rent of the actual rent period plus vacancy rent for vacant period and compare it. Now, expected rent, if it is less than the actual rent plus vacancy rent, means your actual rent plus vacancy rent is more than the expected rent, then your actual rent only will become a GAV. Don't add VR also to GAV, guys. Please keep in mind. Now, if your expected rent is more than actual rent plus vacancy rent, then your GAV will become ER. Only confusion will happen here, guys. If your actual rent plus vacancy rent is more than expected rent, you will take actual rent only as GAV. Don't take a vacancy rent. I hope it is clear. Next, part year let out and part year self-occupied. Let's say, for example, out of 12 months, 8 months you let out the property and 4 months you self-occupied. Not vacancy, self-occupied means you use the property for your own self. One dialogue, keep in mind, even if you let out the property for a single day, it is a let out property only, guys. Even if a single day property is let out, that is treated as fully let out property only. In this case, you will not take a virtual rent. No, you will take expected rent 12 months and actual rent for the actual period only you will compare. You will not add anything here, guys. Only in case of vacancy, I told you, compare full year expected rent with actual rent of actual let out period. No notional rents here. Municipal taxes and interest fully allowed because it is let out property, guys. Next, in case of partial house property, what is a partially let out property? Let's say, for example, there is a big building, 3 floors are there. This is a self-occupied property. These two floors are let out property. 2 by 3, 1 by 3. Yes, yes. In this case, guys, if partial house property means let out property and self-occupied property, split everything, guys. Everything you split in whichever is given in the information, including tax, interest based on portion or plinth area. Area means what? Two portions, let out means 2 by 3. Self-occupied one floor means 1 by 3. How to, sir? See here. Prem owns a house in Madras. 2/3 portion is self-occupied. 1/3 portion is let out. In examination, this kind of question definitely will come, guys. 2/3 portion self-occupied and 1/3 is let out. Now you see only 1/3 only let out means in this let out property you will take actual rent, everything GAV will come. But self-occupied property straight away NAV will become nil. Correct? So for this 2/3 portion NAV will be nil. 1/3 portion let out property will take a GAV, NAV, everything. But mind you, municipal taxes for for self-occupied portion, we will not take anything. Correct? No standard deduction also. Now, municipal value 3 lakhs 270, this and all given. Guys, this information, whatever is given in the question, is for the full building. Now you have to split it here. See here, like this you will split self-occupied property, let out property. See here, 3 lakhs total value is given, 270 total value, 3 lakh 30 total value. Out of that 1/3, 1/3, 1/3 you splitted. So here for 2/3 value you will get sunyam everything. For 1/3 you have to split everything into 13, 13, 13. Then you will take expected rent. But don't split actual rent. Actual rent is for the let out portion only. Why do you split that? So actual rent is the actual rent you will take GAV. Municipal taxes again you will split because municipal taxes 30,000 is for the full building. No, 1/3 only is let out. So you will take that. Standard deduction full you will take on the 90,000 of NAV, but interest you will again split because interest you paid for the full building, only 1/3 is let out, so 1/3 you will take. Now, guys, keep in mind one thing. I told you for optional tax regime, self-occupied property interest deduction is eligible maximum to 2 lakhs, correct? But under default tax regime, self-occupied property, nothing, no interest deduction. Now, let's say for example, this is paying tax under optional tax regime. In that case, self-occupied property interest you will take. Correct? Interest deduction. So 1,20,000 is the total interest you paid. 2/3 optional tax regime. See here I have given 80,000 you will take and loss from house property it will come. Getting it? Next. Jointly or co-owned property. Very simple logic I'll tell you guys. Very simple. First compute the income from house property normally as if the property is not jointly owned. Then once you compute the income from house property at the end, that you split the income from house property in both the owner's hand in the proportion of their ownership, guys. And mind you, interest deduction of 30,000 or 2 lakhs, whatever is there in the self-occupied property case, you will get for person, per person. It is not per house property, correct? So per person means for both the owners you will get separate 30,000 or 2 lakhs of limit. So compute house property as if property is not jointly owned. Divide the income from house property in their ownership ratio. Step 2, and the note is a 30,000 or 2 lakh limit for them separately you will get. Now, lot of times in the question they'll give unrealized rent. Number 1, guys, keep in mind unrealized rent. If you satisfy all the 4 conditions which are given in the unrealized rent, in the unrealized rent case, rule 4 conditions are given. If it is satisfied, reduce from your actual rent, guys. Unrealized rent, reduce from your actual rent. The remaining, the net amount only you offer it as actual rent for your GAV calculation purpose. GAV calculation purpose, actual rent you reduce unrealized rent because you did not realize from the tenant, but you have to satisfy rule 4 conditions are there. If you did not satisfy, don't reduce anything. Full actual rent for the full value you will get it, or you're getting a full value you have to offer it to tax. So reduce from actual rent. Now, lot of times recovery of unrealized rent will happen. So this year you recovered some previous year unrealized rent, then you have to offer it to tax. Then in that case, straight away 30% standard deduction you will get out of the unrealized rent which you realized in this year. In this year in which you realize the rent, whether you have sold that property already does not matter. Ownership does not matter. You realized in this year, you have to offer it to tax. 30% standard deduction you can claim. Now comes the big topic, profits and gains from business or profession. Guys, please hit like button and do comment in the comment section. What are your thoughts and feelings about the way I am teaching, guys? It is very much required. Please give us feedback. Profits and gains from business or profession. And one more thing I'll tell you, guys. I'll tell you one more thing very, very important. Manifestation is true. If you write in the comment section now, I am going to clear damn Jan 26 attempt, definitely you will clear, guys. At least positivity will come. Now PGBP, guys, first concept is depreciation. Very simple. Lot of times in MCQs depreciation concept is tested. Yes, depreciation, asset must be put to use. There are some conditions attached to depreciation. Only if these conditions are met, you can claim depreciation. First, there should be an asset which is put to use, and you should be owner of the asset. If you are not owner of the asset, you cannot claim depreciation, guys. And if the asset is put to use for less than 180 days, mind you, this less than 180 days condition you will only check in the year in which you purchased the asset. Let's say, for example, you purchased the asset in this year but put to use in the next year. Next year, if you use for less than 180, still you will claim full depreciation. In the year in which I purchased the asset, in this year only I am putting use for less than 180 days. In that case, half rate of depreciation only you will be claiming. Then put to use for guys, one date you will keep in mind. 3rd October, keep in mind, guys. 3rd October or before that, if you have put to use, take full rate of depreciation. 4th October or afterwards, if you have put to use, this will be half rate of depreciation, guys. So 3rd October, keep in mind, 3rd October or before that you put to use full rate of depreciation, guys. Put to use on or after 4th October, in that case half rate of depreciation you will claim. Now how to compute depreciation, sir? This is the method. Under WDV or block of assets method, first you will take opening WDV, add all the purchases you will add. Whatever you purchased, put to use more than 182 days, 180 days, put to use less than 180 days, acquired but not put to use. You add all this will form part of block, but you may not claim depreciation on asset which is not put to use, but it will at least form part of block of asset. Less money payable means nothing but the sale price of the assets which you sold during the year. WDV of assets transferred in slum sale, that is a slum sale separate. Now always keep in mind one thing, guys. This less value whatever you are reducing, you can never reduce more than this value, guys. So it can never be negative here. It can be either 0 or positive only, guys. Keep in mind. Depreciation actually allowed, we will compute closing WDV, it will come. Now, additional depreciation conditions, guys. Lot of times in examination, the question will start like, assessee is in the manufacturing business. In that case, it should click to you that in total income computation, especially if the assessee is paying tax under, or you are required to pay tax or compute tax under the optional tax regime, always keep in mind, if it is a manufacturing business, it should click to you guys automatically that additional depreciation also you need to calculate. So new plant and machinery only eligible for additional depreciation. It should be manufacturing business or power generation business. The optional tax regime only is eligible for the additional depreciation. Under default tax regime, guys, very important point, if the question asks you to compute the total income as per the default tax regime, don't give additional depreciation. Only if WDV method is followed you will get, and rate of additional depreciation is 20%. Let's say, for example, in this year when you put to use less than 180 days, this year you take half. 20% half means 10% you take in this year additional depreciation, next year you take the rest 10%, guys. So if asset used less than 180 days, first year 10%, next year another 10% you will claim. Plant and machinery used in office or residence not eligible for additional depreciation. Mind you, the plant and machinery which is eligible for additional depreciation, only the plant and machinery which is used for the production purpose, manufacturing purpose, guys. Forklift truck, the question it will give, forklift truck means for taking the raw materials. If any plant and machinery is used, that will be treated as used for manufacturing only, additional depreciation is eligible. Printing business also eligible for additional depreciation. Some printing machinery if used for printing manufacturing business, printing business, in that case that machinery is also eligible for additional depreciation. Now comes the section 35. Guys, lot of times, guys, total income computation will have section 35 deduction adjustment, guys. Mind you, guys, scientific research, section 35 means scientific research. If in the question scientific research term you see, always go and check what is the tax regime under which you are computing your total tax liability, because you will not get this donation of scientific research donation deduction under default tax regime. You will not get. Are you getting it? So there are two kinds of scientific research expenditure. One is in-house, means within your company you are only doing research, or you're donating to some other entity for scientific research purpose. If in-house research is done, guys, all kind of expenses are allowed, guys. And mind you, guys, if you are doing any capital expenditure, like you are purchasing some a building, in that case no depreciation will be allowed, because already 100% of the expenditure you are claiming as the section 35 deduction. Yes. Now, in-house research, all revenue expenses and capital expenditure also allowed, except land, guys. Keep in mind, except land. If you incur any expenditure, capital expenditure for purchase of land for scientific research purpose, in examination, mind you, don't give the deduction under section 25. Now, in-house research under both optional tax regime and default tax regime give full 100% deduction except land. But keep in mind, for donation which you donate to some other entities for scientific research purpose, only under optional tax regime you will get the deduction. Under default tax regime, if you donate to some other entities, you will not get the deduction, guys. 100% deduction is allowed under optional tax regime. Scientific, social, statistical research institutions, university or Indian institution of technology or college, Indian company, if you see these kind of terms in examination, only then you give the deduction under section 35. Next comes 35 AD, specified business. If a person or a taxpayer assessee is engaged in specified, some list of businesses is given. If you remember, 2-star hotel, 5-star hotel, 100 beds of hospital, beekeeping, logistics business, and this kind of warehousing facility for sugar and all. These kind of any of the specified business, if assessee is doing, in that case, if he incurs any kind of capital expenditure for setting up this business, for starting this business, building is purchased, plant and machinery is purchased, like this, if any assets are purchased, 100% deduction will be allowed on the capital expenditure, guys. On the capital expenditure, whatever expenditure you expended to start this business, to get the infrastructure in place, whatever capital expenditure you expended, 100% is given as deduction under PGBP income, guys. But keep in mind one thing, only 3 incomes are not eligible for section 35 AD deduction: goodwill, financial instruments, and land. If you see in question any of these capital expenditure, don't give 35 AD deduction. Now, guys, keep in mind, very logical thing it is. If you already got 100% deduction on the capital expenditure, then where is the scope of depreciation? 100% already given you as full depreciation only, kind of. So there is no depreciation on the capital expenditure which you did for your specified business. No. Now, there are some conditions attached. It should be a new business, guys. It should not be old business which you are setting up. And the old plant and machinery, maximum 20%. Let's say, for example, you purchased a plant and machinery for 100 lakhs. Out of that, maximum 20 lakhs can be old plant and machinery. Let's say, for example, you purchased 35 lakhs of a plant and machinery. Out of 100, 35 is old. Only till 20 you will get 100% deduction. The excess 15 lakhs of old plant and machinery, you will not get any kind of deduction, guys. Always keep this point in mind. Next, no deduction under default tax regime. This point also you keep in mind, guys. So far 2 things I discussed. Number 1, additional depreciation you will not get under default tax regime. Number 2, you will not get the section 35 donation of scientific research, you will not get under default tax regime. Number 3, the specified business deduction you will not get under default tax regime, guys. And no depreciation allowed. Pre-commencement capital expenditure also fully allowed, means before even starting your business, if you have spent any capital expenditure, that is also fully allowed, guys, in the year in which you commence your operations. And lock-in period of these assets is 8 years. You cannot sell these assets. Next, section 40, guys. There are a lot of payments. The payment for expenditure purpose, if you do any payment, you have to actually deduct TDS. You read the TDS chapter, right? As per the TDS provision, what does it say? When you make a commission payment, when you make a rental payment, these are expenses. Whenever you are making payment, you have to deduct tax. If you did not deduct tax, then section 40A will trigger, guys. If you are running a business, you are paying rental expenditure, you are paying commission expenditure. These expenditure, if you are triggered by the TDS provisions, but you did not deduct the tax, in that case, the disallowance will happen in your PGBP income, guys. You have to pay tax on the expenditure income, on the expenditure also. Now, there are 2 kinds of payments. Payments being made to a resident and payments being made to a non-resident. Guys, always keep in mind, if you made a payment to a non-resident, and you did not deduct the tax, or you deducted but you did not deposit with the government, in that case 100% of the expenditure is disallowed, guys. But in case of a payment being made to a resident, guys, if you are making any payment to resident, in that case only 30% will be disallowed. Are you getting it? Now guys, tomorrow I will be uploading a full-fledged video on only pure top 50 total income adjustments. In that also, these adjustments will be covered. So be tuned in this channel, guys. Definitely you will see that video tomorrow. Top 50 adjustments. Out of that, I can definitely say maximum adjustments in the total income question will come from these 50 adjustments, which I'll be discussing tomorrow, guys. Next. If tax is deducted in the subsequent year, so in this year you made payment, you did not deduct tax. So disallowance happened. If you made payment to non-resident, 100% disallowed. If you made payment to resident, 30% disallowed. But next year you deposited that TDS with the government. In the next year, you will get that deductions, guys. Are you getting it? Next, if payee reports income in a income tax return, then no disallowance. Means, let's say for example, the payee, the payee means the person to whom you made the payment, he voluntarily offered the income to tax. In that case, no disallowance will happen in your hands. Next, section 40B, guys. Section 40B. Following amounts shall be disallowed in the hands of a partnership firm. Guys, keep in mind one thing. Partnership firm, there will be some partners who will be receiving two kinds of payments generally. Either partners remuneration and partners interest on the interest on capital. Those two things are covered here. Yes, following payments will be disallowed in the hands of partnership firm. So if a partnership firm makes excess payment, if partnership firm makes excess payment to the partners, the excess has to be disallowed. But how much excess, sir? You need to read these points. Any payment made to non-working partner, you know, working partner, sleeping partner and all. If you make any, if the partnership firm makes any payment to a non-working partner, straight away disallow, guys. Does not matter because it is a non-working partner. Remuneration, commission, anything bonus or any salary or interest, everything is disallowed straight away in the hands of partnership firm in its books of accounts. Unauthorized payments to working partners. Sir, what is unauthorized, sir? Unauthorized means, you know, partnership deed. In the partnership deed, the deed should authorize the partnership firm to make the payment. If in the partnership deed nothing is been authorized regarding interest or salary, then you cannot give any deduction, guys. Straight away go and disallow it. Any payment before the date of partnership deed, guys, in examination they will test you. Let's say for example, you started the partnership firm in the month of April. In the month of June, you actually created a partnership deed. So from April to June, there was no partnership deed. So in June, you created the partnership deed, but the salary you will be paying from April only. No, now from April to June, since there was no deed, there was no authorization, April to June, whatever salary, whatever interest you pay to partners, that will be disallowed in the hands of partnership firm, guys. Very, very important. Now, you created the deed in the month of June, and in the deed you wrote that we are retrospectively we are authorizing the firm to give the deduction of interest and salary to the partners. Still, it will not be allowed. It will be disallowed because you cannot authorize retrospectively. You can only authorize from the prospective, means from the day you created the deed only you will get the deduction. Interest on partners capital maximum 12% only, you can take it as a deduction, guys. If the firm pays 18% on the interest on 18% interest on the partners contribution on the capital, still you will be eligible to claim deduction of 12% only. Excess 6% you have to disallow. Now coming to remuneration to working partner, guys, mind you, only working partner I told you, non-working partner any payment made you have to disallow. Now remuneration may pay to working partner. If you are making any payment of remuneration to working partner, in that case you will check whether you have made payment within this limit or not. First, for that you have to take book profit. Book profit is nothing but profit as per PGBP before claiming the remuneration deduction under this section, but after claiming interest deduction. So you can claim interest deduction within the limits. So once you take the business profit, claim all the deductions possible except that remuneration expenditure, that is called as book profit. That book profit you will take and you will calculate the limit. So let's say for example, I am taking one example here. Book profit you calculated 10 lakhs. Your actual remuneration which you paid is 8,50,000. Now guys, keep in mind one thing. 8,50,000 actual remuneration you paid, but you have to check the limit now. How to check? First you take book profit of 10 lakhs. On first 6 lakhs of book profit, you will compare higher of these two things. 3 lakhs or 90% of book profit means 3 lakhs or 90% of 6 lakhs. That will be 5 lakh 40,000, whichever is higher is coming. Then the remaining on first 6 lakhs you took here. Total book profit is 10 lakhs. So now remaining is how much here? 4 lakhs. On the balance book profit of 4 lakhs, take 60% of the balance book profit means 60% of 4 lakhs will be 240. So 540 plus 240 is 7 lakh 80 means the partnership firm should have paid maximum 7 lakh 80 only to the partner as remuneration, but they actually paid 8 lakh 50. Excess is how much? 8 lakh 50 minus 7 lakh 80, which is 70,000, which will be disallowed in the hands of partnership firm, guys. Got it? Next, section 40A2. In examination, a lot of times adjustment will be given that to a relative excess expenditure is paid. In that case, you have to disallow. Let's say, for example, generally you make payment of 10,000 to for particular expenditure, but you have made payment of 15,000 to one of your relative for such expenditure. 5,000 is excess. That will be disallowed. Yes, next. 40A3. If you make any payment for a particular expenditure purpose in cash or other than the prescribed modes. What are the prescribed modes? RTGS, NEFT, online book payment, or banking payment, account pay, check and all. Yes, all those are prescribed modes, but you made payment other than the prescribed means you made the payment in cash or crossed check or bearer check. In that case, if you made payment to a single person in a single day of more than exceeding 10,000 rupees, guys, in that case, whatever payment you made for expenditure purpose more than 10,000 to a single person in a single day will be totally disallowed. Mind you, guys, crossed check and bearer check is not a prescribed mode, though it look like check bank. No, it is not. So cross check, bearer check, if you see in question, be very careful. It is not allowed, guys. Yes, next. Section 43B, there are some particular expenditures which you actually make payment, then only you will get the deduction. Otherwise, you will not get the deduction. See, as if you follow mercantile basis method of accounting, generally if any payable expenditure is there, you can claim. No problem, no problem. Even for PGBP income computation, you can claim the payable expenditures if you are following mercantile basis, but these are given specifically under 43B. There are certain expenditures given. These expenditures will be allowed only if payment is done. Payable, it is not allowed. Yes, following expenses are allowed only if actual payment is done on or before the date of return of income. Mind you, your financial year is from April to March, but additional time is also given by the income tax department saying what? So let's say, for example, your financial year is 1st April 2025 till 31st of March 2026. Generally, you should make payment within this period, but the law says, as per 43B, the law says that, let's say, for example, your due date of a return of income is 31st of July 2026. Now, if you make payment from 1st April till 31st of July 26, still the expenditure you can claim, but provided payment is made. So even if you make payment after 31st of March, but till 31st of July means the due date of filing of return of income, still you will be eligible to claim the deduction of expenditure, guys. So till the due date of return of income is very important. What are the expenditures, sir? Tax, duty, cess, fee, employer contribution to RPF, SAF, gratuity, bonus, commission, leave encashment, interest on loan from banks, and Indian Railway payments. And guys, MSME, guys, a lot of times as adjustment this is given. MSME means micro, medium, small enterprises, but this provision is only eligible for small and micro enterprises, not for medium enterprises. Yes, now you purchased some goods from micro or small enterprises. In that case, you have to make payment within the prescribed times here. If the agreement is available between you and the micro or small enterprise, in that case, maximum 45 days within you have to make the payment. If there is no agreement between you and the small and micro enterprise, in that case, you have to make payment within 15 days from the date you purchase the goods. Next. 44AB, tax audit. You have to get your books of accounts audited if your turnover exceeds a particular threshold limit. Tax audit for persons carrying on business or profession. Yes, tax audit under section 44AB. Specified profession means if you are under a specified profession, if your gross receipts are more than or equal to more than 50 lakh rupees, in that case you are generally required for tax audit. If you are doing a business and if your turnover is up to if turnover is more than 1 crore rupees, in that case you are required to do tax audit. But guys, keep in mind one thing: if your receipts in your business and payments in the business, receipts and payments are more than 95% in the prescribed modes only you are doing, means you are following digital Bharat, digital payments only you are doing, more than 95% you are doing through digital payments, in that case your turnover limit will be 10 crores and not 1 crore. Means, let's say for example, my turnover is 7 crores, and if my receipts and payments both more than 95% in prescribed modes I'm doing, I need not get my books of accounts audited. But if my turnover is 8 crores, but maximum of my payments in my business and receipts in business are happening other than prescribed modes, then I have to get my books of accounts audited. There are some special cases like 44 AD, presumptive basis income, 44 ADA. In that case, you are paying tax under the presumptive basis, but income is declared less than the presumptive income of 8%, 6%, 50%. Remember, in that case, if your net total income is more than the basic exemption limit, in that case, you are required to get your books of accounts audited, guys. Now, presumptive income under section 44 AD, mind you, this is only for business 44 AD. For profession, it is ADA. Correct? Now, what is happening is government is telling you for small business fellows, see, for audit, actually audit fee is required. Audit fee is the expenditure. Books of accounts has to be maintained. A lot of janjat is there. Now, the government says that if your turnover is up to 2 crore rupees, you're a small business fellow. In that case, if you are an individual or HUF or a partnership firm, mind you, only resident is covered here. Resident, individual, HUF or a partnership firm, but not LLP, guys. Means if you are a company, LLP and all, this presumptive basis of income you cannot follow. Resident, individual, HUF and partnership firm. And if you are not claiming deduction under 10AA, 80 IA or 80 RRB, in that case, if your total turnover or gross receipt is up to 2 crore rupees, you can offer minimum 8% of turnover or 6% of turnover as your income, and the government will accept. You need not maintain any books of account, but keep in mind, 8% is on those incomes or those receipts which you received in other than prescribed modes. 6% of turnover on the prescribed mode. Let's say for example, your turnover is 1 crore 80 lakhs. Out of 1 crore 80 lakhs, 1 crore you received in banking channels, means in prescribed modes, and 80 lakhs you received in a cash modes. In that case, on 1 crore, if you offer 6% minimum, enough as profit, but on 80 lakhs minimum 8% has to be offered. Got it? Got the clarity? Now, but one more provision here, guys. One more provision here. The turnover limit of 2 crores will increase to 3 crores. Means up to 3 crores also you can offer 8% or 6%, provided if you have cash receipts of less than 9% only. Means the receipts in your business should be more than 95% in prescribed modes. If you are doing digital business, in that case 3 crores higher limit will be given to you. Now comes the profession of 44 AD, income from profession. Guys, keep in mind one thing: eligible assessee is not a HUF here, because HUF cannot run a profession. No, how a family can run a hospital? Not possible. So individual and partnership firm is allowed only other than a LLP. Here the general turnover limit is 50 lakhs, but if your receipts in the profession is more than 95% in the prescribed modes, in that case 75 lakhs of limit will be applicable. And if you offer minimum 50%, enough. Yes. So 50%, let's say for example, 40 lakhs is your total gross receipts in the profession. Straight away 20 lakhs minimum you offer as PGBP income. No need to maintain any books of accounts, nothing, no audit, nothing. 20 lakhs you offer as PGBP, enough. That will be treated as presumptive basis of income. Next, in the case of applying and hiring business, section 44 AE is given, guys. In case of goods carriage business, they can also offer their income under presumptive basis, but provided the first condition is the person should not own more than 10 vehicles. If let's say for example, during any part of the year, any day during the year, if you have owned more than 10 vehicles, you are not eligible for this. Maximum 10 vehicles you should own, and you are in plying, hiring or leasing business. In that case, guys, if you are having a heavy good vehicle, for that you have to offer minimum 1000 rupees per ton. For a per ton, you have to take the total vehicle weight, you will divide it into number of tons, and per ton you will offer ₹1,000 per month it is. Yes, per month for each vehicle, and for other vehicles means the light vehicles 7,500 for each month you will offer for each vehicle. That will give you the presumptive income, guys. Now there are some things which expenses which are not allowed under default taxation, which I already explained. I'll re-explain. First, deduction under section 10AA SEZ I will be discussing in this video only, don't worry. 10AA deduction, you are not eligible if you are paying tax under default taxation. Only these 4 points you keep in mind, guys. 10AA SEZ deduction you will not get. Additional depreciation deduction you will not get under default tax regime. Scientific research 35. I told you donation. Only donation, guys. In-house you will get. In-house research under default tax regime you will get. But donation you will not get. Deduction. Deduction under section 35 AD also not eligible. Only these 4 points you keep in mind under PGBP head. Only these 4 points are not eligible under default tax regime. Rest all remain same under both the tax regime, guys. Now comes the next topic, which is capital gains. We will take just 2 minutes of a break, guys. Just 2 minutes. Okay, guys. The next topic is capital gains. Guys, from this topic, every attempt 3 to 4 marks is definitely asked, and there are a lot of amendments in this topic. Guys, in capital gains, generally we offer to tax the gain on transfer of capital asset. Gain is nothing but the profit. Transfer means sale, exchange, relinquishment. Some definition is given, you can check that. And capital asset has to be transferred. Guys, mind you, capital asset definition is given. Property of any kind, tangible, intangible, movable, immovable, whatever property is there, if you are transferring, and any gain you are receiving by that transfer, that income will be taxed under the capital gains head only, guys. Now keep in mind one thing, guys. There are some, generally capital gain has to be taxed in the year in which the transfer takes place. Let's say for example, I am selling a building in this year 2025-26 financial year. I have to pay tax in this year. But there are some special cases in which you will not pay tax in the year in which transfer took place, but you will pay tax in some other year. The first one is insurance receipts. Let's say for example, in the question it says that the building got demolished in 2021-22, but the compensation from the insurance commission in insurance company was received in 2023-24. In that case, tax will not be levied in this year, but in the year in which the insurance receipts were received, guys. The next one is conversion of capital asset into stock in trade. Guys, keep in mind one thing. Whenever a capital asset is converted into stock in trade, in that case, two kinds of tax will arrive. One is capital gain, the other is PGBP. Now, the day on which the conversion will happen, till that date, you will calculate the capital gain, guys. How will you calculate capital gain? There is no full value of consideration. You will take fair market value as on the date of conversion as full value of consideration for capital gain purpose, and you will reduce actual cost of acquisition. Now for PGBP purpose, when you sell the stock in trade, PGBP will come. The PGBP purpose, the actual sale value you will take, correct? Actual sale value of the stock in trade you will take. From that you will reduce the fair market value which you have used here for the PGBP computation purpose, guys. Yes, next. So you will get two kinds of taxes when you convert. And you will pay tax in the year in which the stock in trade gets sold. Now, in the case of compulsory acquisition, guys, what is a compulsory acquisition? Let's say, for example, your building has been compulsorily acquired by the government. In that case, government will give you compensation, of course. Now, there are two kinds of compensation, guys. Original compensation and enhanced compensation. Original compensation means, let's say, for example, when your building was acquired by the government initially told that they will give you 10 lakhs as compensation, for example. Now, government told you that they will give you compensation of 10 lakh rupees. That is called initial compensation. But you were not satisfied with the 10 lakhs. You went to court of law. You filed a case law. You filed a case in the government, and the government told that, okay, he should be paid 12 lakhs and not 10 lakhs. In that case, your enhanced compensation will become 2 lakhs, guys, because this 12 lakhs is revised compensation. In that, enhancement has happened up to the extent of 2 lakhs. Now, keep in mind some important points. Original compensation, if you received in bulk amount, full 10 lakhs in one shot, so you will tax in the year in which the original compensation is received. How will you compute the capital gain? Very simple. 10 lakhs, full value of consideration will be 10 lakhs. Less cost of acquisition you will do. Whatever amount is there, that will give you the capital gain, long term or short term, depending on the time. Correct? Now, keep in mind one thing. Once you received the enhanced compensation in bulk, you are offering it to tax in a one shot. But let's say, for example, government told that this 10 lakhs, I will not give you in one shot. Government is telling you that we will pay you this 10 lakhs in installments. We will pay you in installments, means this 10 lakhs will be paid in 5 equal installments. 2 lakhs, 2 lakhs, 2 lakhs, 2 lakhs for 5 years will pay. In that case, you will pay tax in the first year in which you received the first installment. So here, if initial compensation is received in installments, then it will be taxable in the year the first installment is received. You cannot say, sir, I am receiving in installments. No, I'll pay tax in installments. No, you will pay tax on initial compensation, original compensation in the first year in you received the first installment. Now, when coming to the enhanced compensation, guys, of 2 lakh rupees, sir, when should I pay tax? Of course, you will pay tax on the enhanced compensation in the year in which you will receive the enhanced compensation, guys. Keep in mind this point also. Now, so when you will compute the capital gain, now keep in mind one thing, guys. This enhanced compensation, when you will receive, when you have to offer it to tax, you will not again reduce the cost of acquisition from that because you already reduced it. Now, capital asset, there are two kinds of capital asset, guys. Long-term and short-term capital asset. Long-term capital asset or short-term capital asset, how to decide, sir? Very simple. That will depend on the period of holding. Now, what is period of holding, sir? Period of holding is nothing but the day from which you acquired the asset, till the date which you sold the asset, the duration for which you are holding the asset is called period of holding. Let's say, for example, I purchased an asset on 15th of July 2011. I sold the asset on 31st of March 2022. So for this duration, I am holding the asset, that will be called as period of holding, guys. Yes, next. Keep in mind one thing, there is an amendment here. If you are transferring the asset, guys, mind you, the term here is transfer, very, very important, guys. Transfer term is very, very important. If you are transferring the asset, means you are computing the tax liability in this year, capital gain tax liability. And if you see that the transfer of the asset happened before 23 July 2024, then you will compute, you will find out or determine the nature of capital gain based on this table. But if your transfer of the asset happened on or after 23rd of July 2024, in that case, you will use this table to determine the nature of capital gain, guys. Yes, in this table, it says that listed security other than unit of equity oriented fund, zero coupon bond. For this, you will apply 12 months. So less than or equal to 12 months if you held, that is a short-term capital asset or capital gain. And if you hold for more than 12 months, it is long-term. Unlisted shares and land or building or both, if it is held up to 24 months, then it is short-term. If more than 24 months, long-term. All other capital assets you should take 36 months. But mind you, guys, in examination, if it says if the transfer took place on or after 23rd July, very simple, it is only two duration it is given, 24 months and 12 months. In case of listed security, including all units and zero coupon bond, 12 months you will apply. And all other capital assets you will apply 24 months, guys. Next, taxation in case of liquidation. You know very well. Liquidation, what is liquidation? Company gets liquidated. Whatever left out assets are there, that will be given to the shareholders. Now, shareholders or the owners. Shareholders invested in the shares of the company. For that investment, return what they are getting on the date of liquidation, assets and money they are receiving. Correct? Now, when the liquidation will happen, when the shareholder will receive this money, assets from the company, the capital gain has to be arised because the shares are being sold. No, company itself is getting liquidated, means the shares are getting sold in the hands of shareholder. Correct? Now, taxation in the hands of shareholder. Capital gain, how to compute, sir? Full value of consideration will be what? Money, what he is receiving from the company. Fair market value of assets which are being distributed, less deemed dividend. Guys, remember, in case of income from other sources, there is a deemed dividend concept. There is a section 222C which says that in the case of liquidation, to the extent of accumulated profits, the company which it distributes to the shareholders, that will be treated as deemed dividend. If already you are deemed dividend, you are offering it to IFOS, you cannot again tax it under a full value of consideration or capital gain. So that is being removed, because you see here, distribution of accumulated profits, deemed dividend, IFOS, it will be taxed in the hands of shareholder. That is why we are removing this part here. So from full value of consideration, you will remove cost of acquisition or indexed cost of acquisition. Next, buyback. Guys, in this also amendment is there. High chances this may be asked as a separate question, guys. Now, what is buyback? Company buys back its own shares from its shareholders. That is called a buyback. Now, in buyback, what will happen? First, I had invested in the shares. Company is buying my own shares from me. Correct. Now, in the case of before and after, two dates are there. Before 1/10/2024, only in the hands of company the tax was levied. In the hands of shareholder, nothing was levied. Guys, I'll take one small example. Let's say, for example, I invested 10,000 rupees in a company. Company is buying back shares at 12,000 rupees. So I am getting a benefit of 2,000 rupees from the company. Correct? I invested 10,000. Let's say, for example, one share only I have. One share I bought for 10,000. Company is buying back this own share, this same share for 12,000 from me. So company will pay me 12,000. I'll give back the share to the company. So benefit I am getting 2,000. This logic you apply now here. In hands of company. So before 1/10/2024, in the hands of company, you are only getting benefit 2,000, but in the hands of company it used to tax. How? Tax on distributed income means this income is distributed by the company to So on this 2,000, company used to pay tax at the rate of 20%, guys, and surcharge and cess also additional. Distributed income is buyback price minus issue price. Buyback price is 12,000 minus issue price, that is 2,000 rupees. Getting it? And in the hands of shareholder, it used to be exempt. Means this 2,000, nothing I should pay tax being a shareholder. This was the scenario before 1/10/2024. But the law got amended on or after 1/10/2024. The law got amended and it says what? In the hands of company, ulta now, no tax. Earlier, company used to pay tax, but now no tax in the hands of company. But in the hands of shareholder, this tax will come. Now keep in mind one thing. IFOS and capital both will come. IFOS full buyback amount. Now the law says this 12,000 amount total will be treated as income from other source in my hand. Now you will tell, sir, 2,000 only, no sir, income. Why I am offering 12,000? Guys, wait. 12,000 is not your income. I understand only 2,000 is your income, but there is a twist. Government says that whatever buyback amount is there, 12,000, treat it as IFOS in your hand. See here, full buyback amount, deemed dividend, you will treat it under section 222F, this 12,000 rupees. Then the law says this 10,000 is there, no, it will be treated as capital gain. Full value of consideration you take nil. Actual cost of acquisition you remove here, this 10,000 rupees. From here you will get a negative 10,000 here, guys. Positive 12,000. Wait a second. Positive 12,000 under IFOS, negative 10,000 under capital gain. Net amount is what? 2,000 ultimately taxed in your hands. Getting it? Next. How to compute capital gains, sir? There is a method given, beautiful table. First, think logically. Sale value minus purchase value is your gain, correct? So first, full value of consideration, you will take full amount. Full value of consideration is nothing but the sale value. Let's say transfer related expenses. If you have any incurred any stamp duty expenses or brokerage, anything, you can remove. That will give you net sale consideration. From that, you can remove cost of acquisition and cost of improvement. Guys, mind you, there is an amendment. Earlier, indexation was also eligible. Now, indexation is not available, guys. So there is a cutoff date. I will explain that also. But generally, if you transfer before the date given, in that case, indexed cost of acquisition and indexed cost of improvement you can take. But there is a cutoff date, and that will give you capital gain. STT not allowed. Securities transaction tax which you pay on the transfer of assets like shares, you will not be eligible now. Now, guys, indexation benefit. Indexation benefit, keep in mind one thing, guys. Indexation benefit transfer if happened before 23rd of July 2024, only then it is available. If you transfer the asset on or after 23rd July 2024, no index benefit, guys. No index benefit. Forget about index benefit totally, guys. There is one provision. If a land or building or both transferred by an individual, purchased before 23rd of July 2024 but transferred after 23rd of July 2024, you can pay tax at the rate of 12.5% without indexation and 20% with indexation. That only at the time of computation of capital gain tax liability only you will take. Here at the time of computing capital gain you will not take that. That I will explain at the end of this video. Now, cost of acquisition in case of long-term capital asset under section 112A, guys. In case of three kinds of capital assets, guys. Number one, business trust unit, equity shares and equity oriented units. These are all listed, guys. Honeybee, you know Honeybee, BWB, you remember like that. B means business trust unit, E means equity shares, E means equity oriented units. In these three cases, guys, if you acquired any of these three on or before 31st of Jan 2018, but you are transferring or selling it after 31st of Jan 2018, guys, in that case, keep in mind the cost of acquisition shall be higher of this, guys. Very, very important provision. Actual cost of acquisition you will take, and then you will compare it with the lower of these two. First, you will take the fair market value as on 31st of Jan 2018, and the sale value or full value of consideration you will take. Whichever is lower you will take, that you will compare with your actual cost of acquisition. Whichever is higher will come, that will become your cost of acquisition. Mind you, this is applicable only in case of three kinds of assets: B, Honeybee. E for business trust unit, E for equity shares, and equity oriented units listed, guys. Acquisition date on or before 31st of Jan and transferred after. So keep in mind this. Indexation benefit is not available for 112A income. Now, slum sale, guys, lot of times in examination, slum sale separate question will be asked for 6 marks. Very, very important. Slum sale is nothing but a unit is totally transferred for a lump sum consideration separately, guys. Lump sum consideration, it is transferred. Now, how do I know, sir, whether the capital gain which I will receive will be a long term or a short term capital gain? Guys, very simple. If you were holding the unit for more than 36 months, it is a long term. If you're holding the unit or you are owning the unit for less than 36 months, that will be called as a short term capital gain, guys. Next. Sir, what will be the long-term capital gain tax rate, sir? Very simple. If you are transferring before 23rd of July, 20% normal, and 12.5% if transferred or the slum sale happened after the 23rd of July. Indexation benefit anyway not available or applicable, not applicable under the slum sale, guys. And short-term capital gain tax at normal tax rates, guys. Now, how to compute, sir, the capital gain? Very simple. First, you take full value of consideration, simple sale value, but sale value will be higher of these two things. Full value of consideration will be higher of FMV1 and FMV2. Sir, what is FMV1? FMV1 is FMV of capital assets on the date of slum sale, means the fair market value of the capital assets which you are transferring in the slum sale, and the fair market value 2 will be FMV of consideration which you are receiving. Let's say, for example, you are receiving money and you are receiving some assets also against this slum sale. In that case, the fair market value of the money and the assets which you are receiving, these two fair market, you will take fair market value, whichever is higher will be there, that will become your full value of consideration. From that you remove the net worth. Now comes very, very important, guys. Whenever you compute net worth is nothing but what? Assets minus liabilities. But assets, whenever you take, in that case, assets, whenever you take depreciable assets, you take WDV value. Self-generated goodwill, if you have anything, nil you take. If there is any asset on which you already claimed 35 AD, you take it as nil, and all other assets and liabilities you take book value, guys, and ignore revaluation of assets, guys, and minus value of liabilities you will get your net worth. If you remove from the full value of consideration, you will get the capital gain or loss, guys. Getting it? Net worth can be negative, but can never be negative, guys. If it is a negative, take the net worth as a nil, guys. Yes, next. In case of transfer of asset, guys, a lot of times what happens, let's say, for example, the actual sale value is 10 lakh rupees. Actual value is 10 lakhs and the stamp duty value is actually 13 lakh rupees, for example. Actual is 10 lakhs. Now, you will have to compare actual sale value with the stamp duty value. If the stamp duty value is more than 110% of actual sale value, in that case, always take the stamp duty value as your full value of consideration if you are transferring land or building or both, guys. Getting it? But let's say, for example, if it is not 13 lakhs here, so in this first case I need to take 13 lakhs, correct? Full value of consideration, because 110% of 10 lakhs will be 11 lakhs only. But here my stamp duty value is 13 lakhs which exceeded. So first case scenario 13 lakhs I'll take. But let's say, for example, second scenario, my stamp duty value is 10 lakh 80,000. Stamp duty value is 10 lakh 80,000. In that case, is my stamp duty value exceeding 11 lakhs? No. Now, is my stamp duty value exceeding 10 lakhs? Yes, but still guys, mind you, this 10 lakh 80 is not more than 110% of the actual sale consideration. So I will take full value of consideration 10 lakhs only, guys. Are you getting it? So very simple, guys. First take actual sale consideration. Come take 110% of actual sale consideration. Okay. 110% compare with the stamp duty value. If stamp duty value is more than the 110%, take the stamp duty value as full value of consideration. If a stamp duty value is less than the 110%, take the actual full value of consideration or actual sale value only. I hope that is clear. That is what this provision is saying. But now there is one problem. Let's say, for example, the date of agreement and the date of registration. Let's say, for example, date of agreement was 15th of July 2024. Date of registration is 30th of September 2024. Now on date of registration, date of agreement, the stamp duty value was 15 lakhs. And on the date of registration, the stamp duty value is 18 lakhs. Now there will be full confusion. Shall I take 18 lakhs or which SDV shall I take? Is 18 lakhs or 15 lakhs? Now the law says, if on the date of agreement, on or before the date of agreement, if you took any advance payment from the buyer in prescribed modes, in that case take the SDV value as on the date of agreement. If you did not take any kind of advance payment as on the date of agreement, in that case take the stamp duty value as of the date of registration. This is what is given in this provision, guys. You can read it later. Now advance money forfeited. Advance money forfeited means you are selling a property, advance money someone gave, then the deal did not happen, so you forfeited means you did not give back the advance money to the buyer. In that case, that is called as advance money forfeited. Guys, if you forfeited before 1/4/2014, then deduct from the cost of acquisition when you will sell the property. So let's say, for example, buyer 1, buyer 2. Buyer 1 gave you 4 lakhs advance and the deal did not happen, you forfeited it. Now buyer 2 came, he is actually selling the you are selling the property to buyer 2 only actually. Now here you will compute no cost of acquisition, sorry, wait a second, full value of consideration, so on so amount less cost of acquisition. You will do not to compute the capital gain. In that case, this actual cost of acquisition, how much ever is there, from that you have to reduce this 4 lakhs and then only compute the capital gain. But if you forfeited the amount on or after 1/4/2014, then directly this 4 lakhs will be taxed under income from other sources, guys. Yes. Okay. Next, there are some exemptions. You know very well there are some exemptions under the capital gains, guys. I uploaded a separate video on capital gains. In that case, you can beautifully, that is properly explained. 54, very simple. If you are selling a land or building or both, long-term capital gain you are getting, that long-term capital gain you have to reinvest in another house property, not land or building or both, house property. If you are selling a house property and you have to again reinvest in a house property, in that case you get 54 exemption, guys. If you are selling only to the extent of one house property, in that case you can reinvest in one house property. If you are selling two house properties, you can actually to the extent of 2 crores, if you have 2 crores only to the, if your long term capital gain is only up to 2 crores, in that case you can invest in 2 house properties. If your long term capital gain is more than 2 crore rupees, you can invest in only one long term capital house property, which is house property, guys. Next, 54 EC means if you are transferring any long term capital asset and if you want to invest in NHAI bonds, RECL bonds and all. In this year, HUDCO bond is also added here. So if you invest a maximum to the extent of 50 lakhs within 6 months, you have to invest. In that case, 54 EC exemption you will get. 54 F is very simple. You transfer any kind of asset, but you have to purchase a house property. In that case, 54 F you will get. You can go and check the capital gain discussion, which I have done separately. Now, tax on listed B. B means I already told you business trust unit and equity share and equity oriented units. In this case, that to listed, guys. In this case, transfer of B is happening before 23rd July 24 or on or after 23rd July. The tax rates are different, guys. If you are transferring any of these 3 units before you are transferring, guys, always you check the transfer date, guys, not purchase date. If you are transferring before, In that case, short-term capital gain will be taxed under 111A at the rate of 15%. Long-term capital gain will be taxed under 112A above 1,25,000 income only will be taxed at the rate of 10%, guys. But if you transferred on or after 23rd July 2024, short-term capital gain will be taxed at 111A at the rate of 20%, and long-term capital gain under 1128 will be taxed beyond 1,25,000 of long-term capital gain at the rate of 12.5%. It will be taxed, guys. No index benefit will be available for this. Mind you, this is very, very important. Listed, only these three units. The tax rates are this, guys. The special tax rate income is this, the special incomes. Now, tax on capital gain, what are the tax rates, sir? Simple, guys. First learn 111A, then 112A, then whatever rest is there, it will be easy for you. First 111A. Short-term capital gain on B. I told you listed three units. 111A will apply. Special tax rate, just now I told you. All other short-term capital gains, simply apply the normal tax rate, guys, slab tax rates. Short-term capital gain is covered. Short-term capital gain, what are the tax rates? Very simple. Number one, if you are selling, if your short-term capital gain is from the B, in that case, 111A you apply special tax rates. But any other capital asset you are selling, in that case, short-term capital gain tax at slab rates. Now, long-term capital gain on B, 1128 tax rates you apply slab rates, the special tax rates, and all other will be taxed under 112 special rate, guys. Yes, most important this one. There is a long-term capital gain on land or building or both purchased before 23rd July 2024. This is applicable only in the case of individual, guys, mind you. Purchased before 23rd of July but transferred after 23rd of July. So you purchase, let's say for example, you purchased a building on, let's say for example, 15th of July 2021. Is it before 23rd of July 2024? Yes. Now you are selling this building on 30th of September 2025. Is it after the sale date? The sale date is after 23rd of July 2024. Yes, you are an individual. You are having land or building or both, purchased before 23rd July 2024 and sold after 23rd of July 2024. In that case, guys, keep in mind, you will not take index benefit for long-term capital gain computation. Means when you will take a full value of consideration, normally you take less. Cost of acquisition only you will take, you will not index it. That will come to your capital gain, long-term capital gain. No index benefit. But on this long-term capital gain, you have to pay tax, right? You have to pay tax, right? At the time of you have to pay, calculate the tax liability. You will tax liability. Let's say for example, this long-term capital gain is coming 2 lakh rupees. On this 2 lakh rupees, when you have to compute tax, on 2 lakhs when you will compute tax liability, two things you will compare. Number one, 12.5% with indexation, without indexation, and 20% with indexation. Means when you will calculate the tax liability as per 20% rate, you will do the computation again with indexation benefit only for computation of tax purpose. And this 12.5% you will apply straight away on this amount. You will compare whichever is more beneficial. You will have to pay tax according to that. This is most important. I somehow feel that this adjustment will come in my practice batch. We have done some questions also. So guys, that will be helpful for you. Next, the next topic is income from other sources, guys. Whatever income is there, if it does not fall under those 4 heads of income, straight away come and put it under income from other sources. First one is dividend. Dividend, you know, it is a other income. So normal dividend, deemed dividend. Sir, what is normal dividend? Normally, dividend is declared by the company, that will be treated as dividend income in the hands of shareholder. But there are some deemed dividends also, in which one of the most important is 222E, guys. There are two kinds of scenario in 222E. Case 1. Let's say, for example, there is a private limited company only. This is applicable. This is not applicable in the case of public limited companies, guys. There is a private limited company. There is a shareholder who invested in this company. Now, this shareholder is holding more than or equal to 10% of the voting power in this company. These are the conditions, guys. Condition number 1, private limited company. Condition number 2, shareholder is holding more than 10% of the shareholder of voting power in the company. Condition number 3, the private limited company has given any loan or advance to the shareholder. Condition number 4, if this loan or advance is given by the company to the shareholder. In that case, whatever loan or advance received by the shareholder will be treated as deemed dividend in the hands of shareholder. Full loan amount will be taxed as deemed dividend in the hands of shareholder under IFOS. Now, scenario number 2. Earlier, directly company gave the loan to the shareholder, but in this scenario, let's say for example, private limited company, there is a shareholder and there is a concern. Concern means partnership firm or AOP or BOI. Now, see, shareholder is having substantial interest in this concern. Private limited company is this. Now, mind you, shareholder directly did not hold a now, mind you, loan and advance is not directly given by the company to the shareholder. Loan and advance is not directly given by the company to the shareholder. Company gave the loan and advance to the concern in which the shareholder has a substantial interest. In that case, even though the loan and advance is given to the concern, deemed dividend in the hands of concern will happen, because though the concern is not investing directly in the company, shareholder only invested, but the shareholder has a substantial interest in this concern. So any loan or advance. So what are the conditions here? Number 1, there should be a private limited company. There is a shareholder who is holding more than 10% of voting power, and this shareholder also has substantial interest in one of the concerns. And this private limited company, if it gives any loan to the concern, this loan will be treated as deemed dividend in the hands of concern, and it will be taxed under the head IFOS in the hands of the concern, guys. Next, there are some other incomes which are taxable under income from other sources. First one is casual incomes, guys, like winnings, straight away winnings, guys, always taxed at the rate of 30%. No expenses allowed, guys. No chapter 6 deductions, guys, and no basic exemption limit. Means you have to pay tax at the rate of 30% on the casual incomes. Interest on compensation, enhanced compensation, just now I told you compulsory acquisition will happen. If you receive any interest on enhanced compensation, flat to 50% exemption you give. In the examination, they'll tell interest on enhanced exemption, enhanced compensation or original compensation received 5 lakhs. In that case, less, flat exemption 50% you give, only 2,50,000 you tax. Advance money forfeited, just now I told you on or after 1/4/2014, if you forfeit any advance amount, that will be treated as income from other source. Rental income of machinery, furniture, if you receive any rental income, tax it under income from other source. Interest on any securities, amount received on under any key man insurance policy, also taxed under income from other source only. Now, gift taxation, lot of times MCQ is asked from gift taxation, guys, very very important. Guys, keep in mind one thing. Gift you are receiving, always you should receive a capital asset only, guys. If you do not receive any property as a capital asset, as a gift, then it is not taxed. Let's say for example, someone gave me mobile as gift, not taxed, not taxed. Mobile maybe 2 lakhs worth of mobile, not taxed, because mobile is not a capital asset. Definition is given here. Only if you receive a particular asset which is defined here, like jewelry, archaeological painting, drawing, or digital assets or shares. These are only if you receive as gift, it is taxed. If you receive any car as gift, it is not taxed. You received any calculator as tax, not. You received as a laptop as gift, not taxed, because only those assets which you receive, only those assets which are defined under the act, only that if you receive as gift, then only it is taxed, guys. But money is taxed because it is asset. Yes, money or property received without consideration for or inadequate consideration. Without consideration means you did not pay even a single rupee, you are receiving full as gift. Inadequate consideration means you paid some consideration, but let's say for example, value is 10 lakhs of that asset, you paid only 2 lakhs. That is called inadequate consideration. Are you getting it? Next, money or cash received, whole amount will be taxed if you receive more than 50,000 rupees, guys. Let's say for example, someone gave you 60,000 as gift to cash to you. In that case, full 60,000 will be taxed in your hands, not 10,000 excess. No. Full 60,000 taxed. Yes, if someone is gifted you 40,000, nothing will be taxed. Land or building or both without consideration you receive, in that case, full stamp duty value which is exceeding 50,000 rupees, full stamp duty value will be taxed. If let's say for example, the stamp duty value of the building which you received is 40,000 only, nothing will be taxed because gift value itself not exceeded 50,000. But let's say for example, the stamp duty value exceeds 50,000 rupees, full stamp duty value will be treated as gift in your hands. Immovable property for inadequate consideration means you paid some consideration. Let's say for example, you received a property worth of 10 lakhs from someone, you paid 2 lakhs. Now, the difference here is 8 lakhs benefit you are getting. This 8 lakhs is more than 50,000, no, then it will be taxed. But let's say, for example, here you paid 9 lakhs 70,000. Guys, keep in mind, you paid 9 lakhs 70,000. Now, what is the benefit you are getting? Only 30,000. This 30,000 is not exceeding 50,000. Nothing will be taxed in your hands, guys. Got it? So, 50,000 is the limit here also. So, taxable if 50,000 and 10% of the consideration, that 110% value you have to consider. Movable property received without consideration or inadequate consideration. Movable property, it says, guys, property definition is given. Again, I'm telling you, movable car is also movable only, but it is not property definition. It is not coming, so it will not be taxed. Movable mobile also movable only, but it is not considered under the property definition. So before going to examination, check at the property definition, guys. In that, jewelry, shares, cash, bank, everything has coming. So that if you receive, that will be taxed. So without consideration, 50,000, 50,000. Simple, guys. If the benefit which you are deriving is more than 50,000, you tax it. Now, 56 to 10 means the gift taxation does not apply in below cases. Means in these cases, even if you receive for inadequate consideration or free of cost, or anyone gifted you, in these cases, whatever amount, 1 lakh, 2 lakh, 10 crores, whatever, it is not taxed. First, from relative. Sir, I can call any person as relative or no? There is a relative definition given. If only any of that relative has given you, mind you, only the capital assets, that will be totally exempt, guys. On marriage occasion you receive, sir, I receive on anniversary, sir, no, it is taxed. On only marriage day, sir, I received on birthday, sir, it is taxed only on marriage. Inheritance or will, death, local authority, if any local authority gives you, or fund, a foundation, university, hospital, medical institution, trust, if any of these persons are giving you gift, any kind of capital asset, whatever value, nothing is taxed. Private trust, COVID-19, during COVID-19 someone gifted you money, some for treatment and all, totally it is a exempt in your hands. Now, whatever we have seen is so far the taxation of income from other sources. Now we will see from that income what kind of deduction of expenditures you can claim. First one is interest expenditure spent for earning dividend income. Guys, a lot of times this has been asked, guys. Let's say, for example, your dividend income which you received is 10 lakh rupees. Now, dividend where from you will receive? From the shares. From the shares means you invested some amount in shares. Now, for investing the amount in shares, let's say, for example, you actually took loan to invest in these shares. For that loan, you are paying interest, no, right? That interest, you can claim it as deduction. Interest on loan, you can claim it as deduction, guys. Let's say, for example, you actually paid interest on loan of 3 lakhs, but the law says this interest deduction on the loan from the dividend income you can claim maximum to the extent of 20% of dividend amount. Means maximum you can claim 2 lakhs only. 2 lakhs is nothing but 20% of 10 lakhs. So only 2 lakhs they will give you as deduction. Yes, let me read this provision for you now. See here. Interest expense spent for earning dividend income or income on units of a mutual fund is allowed as deduction subject to maximum of 20% of such income. Next. No deduction of in respect of expenditure in case of deemed dividend on account of buyback of shares. Deemed dividend you will not get any exemption. Only on actual dividend you will get deduction of expenditure. Any sum paid by of commission remuneration to a banker for earning interest on securities is allowed. So you paid any commission for a let's say, for example, you are doing a fixed deposit in a bank. For that you paid some brokerage charges and all. So whatever interest income you will get from that, you can take that expenditure. Following expenses can be claimed for earning income from letting on hire of machinery and plant and furniture. So you are letting any machinery, plant or furniture, that rental income you have to offer it under IFOS. For that you can claim some expenditure. What kind of expenditure? Current repairs, premium in respect of any insurance you paid, and normal depreciation you can claim here. Deduction against income in case of in case of family pension. If any family pension is received, in case of a person has already been died, so family pension is received by the legal heirs, so that will be taxed under IFOS, and that income can claim, actually family pension can be for that family pension income they can claim the deduction of expenditure, sum equal to 33% of such income can be claimed. But mind you, guys, 15% in case of optional 15,000 maximum you can claim 15,000 in case of optional tax regime, and 25,000 in case of default tax regime, guys. So that ends our discussion on income from other sources. Now let's move on to the next topic, which is clubbing of income. Guys, keep in mind one thing. Every attempt clubbing of income question is asked. Now, clubbing of income, there are 3-4 cases. First of all, clubbing in case of spouse income, clubbing in case of daughter-in-law's income, clubbing in case of minor's income, guys. Three kinds of incomes are clubbed generally: spouse, daughter-in-law, and minor income. These three are clubbed. First, spouse. Transfer of asset to spouse without consideration for inadequate consideration. You transferred any income or any house, any asset to spouse. Spouse means husband transfers to wife or wife transfers to husband for without consideration or inadequate consideration. In that case, whatever income transferred or whatever asset transferred, on that, from that asset, any rental income or any other interest income, dividend income is coming, that income has to be clubbed in the hands of transferor. Are you getting it? So, but keep in mind one thing, except house property, guys. House property you will not club, because for house property what happens? I'll take one example. Let's say, for example, there is one husband. This is wife. If a husband transfers some money, for example, and wife invested in some shares, and a dividend income is coming, this dividend income will be clubbed in the hands of husband. Number two, if money is transferred by the husband to for inadequate consideration to wife, and wife invested in a bank FD, interest income is coming. Interest income will be clubbed in the hands of husband. But keep in mind one thing, guys, very very important point. If house property is transferred by spouse to the wife, and from that rental income is coming, it will not be clubbed in the hands of husband. Under club provisions it will not be clubbed, because this rental income ultimately it will be taxed in the hands of husband only, but under income from house property it will be taxed, guys, due to, not because of clubbing provisions, due to deemed ownership. There is one concept under income from house property. In that case it will be taxed, guys. Keep in mind one thing. Now in this case here, in this case of person, it can be wife or minor child also, guys. Spouse or minor child, house property is transferred, rental income will be treated untaxed as a deemed owner in the hands of transferor under income from house property. But one exception, guys. If minor married daughter is there, married daughter, in that case, guys, keep in mind one thing. So I'm changing the scenario here. One second, I'm changing the scenario here, guys. I'm changing the scenario here. One second. So this lady here, this Bomma here is minor married daughter, and house property transferred by the parent to the minor married daughter, and rental income is earned. Then, guys, keep in mind, clubbing will happen. Deemed owner concept will not come, guys. One second. Deemed owner concept will not come, under clubbing will happen under clubbing provisions, this rental income, guys. Yes, I hope that is clear. Okay, next. So to your spouse, if you transfer any asset other than house property, then in that case, whatever income generated out of that asset is clubbed in the hands of the transferor spouse. Rental income taxed in the hands of transferor only, but as a deemed owner under income from house property, not because of clubbing provisions. Now, in case of separation, means let's say, for example, divorce happened between a husband and wife. In that case, if any asset is transferred without adequate consideration to the spouse, then clubbing provisions will not happen. Income earned from reinvesting the original income cannot be clubbed. Let's say, for example, in my scenario, husband transferred some money to wife, husband, money. Okay, out of that interest income came. Interest will be clubbed in the hands of husband. Now this interest, again wife reinvested in some other shares, and the dividend were come. This dividend will not be clubbed in the hands husband's hand, because it is interest, it is income from income. Yes, next. If the asset invested in business, then proportionate profit taxable. So in this case, let's say, for example, if husband transferred some money to wife invested this money in some business. In that case, what will happen? Of course, PGBP profit will come. No, that profit will proportionately will be taxed in the hands of husband. How proportionately, sir? So income from business will be taxed. Total income from of that business you take. Total income from the business of that business you take in that year into gift amount, how much ever invested in that business you take, and divide by opening capital, total capital whatever was there in the business on the first day of the previous year you take, and you apply this formula. Whatever clubbing has to be done, that amount will come that you have to club. Remuneration received by spouse from a concern in which assessee has substantial interest. Lot of times has been asked in examination. Let's say for example, guys, let's say for example, there is one organization. There is one organization. There is one organization. One second. There is one organization, partnership firm. In that case, husband is partner or has substantial interest. It can be company or partnership firm, whatever. Substantial interest is there in this of a husband interest. Now, from this partnership firm or company, wife is receiving salary income. Salary income. In that case, this salary income will be clubbed in the hands of husband because this husband has substantial interest in this entity. From this entity, wife is receiving salary. Salary will be taxed in the hands of husband. But this club will happen only if wife do not have required qualification. Let's say for example, wife itself is a chartered accountant. She is very much qualified. She is an engineer. She is a doctor, whatever. In that case, clubbing will not happen because she has the required qualification, guys. So clubbing will happen only if there is no required qualification and from the concern in which the husband or spouse has substantial interest, the spouse is getting any remuneration received by a spouse from a concern in which assessee has substantial interest 20% or more. No clubbing if professional skills exist, guys. Clubbing of income in daughter-in-law. I told you 3% clubbing will happen. Spouse, daughter-in-law and minor. So first daughter-in-law, second one is daughter-in-law. Any income from asset transferred by father-in-law or mother-in-law shall be clubbed in the hands of father-in-law or mother-in-law. If further investment is done in business, proportionate income will be taxed here also. Clubbing in case of minor, maximum of the times in examination, either a spouse or minor income, minor clubbing they will ask. Guys, generally keep in mind, generally any income earned by minor should be clubbed in the hands of parents only. Sir, which parents, sir? Whichever parent has the highest income, in that parent's hand only you have to club. But let's say for example, only in some special cases clubbing will not be happen in the minor's income. Number one, if the minor has some skill, dance India dancer, Saregamapa, he or she went and won some income, that income will not be clubbed because it is because of the skill, talent, labor, whatever hard earned money it is of the own child, that will be taxed in the hands of child only. Then the clubbing will not happen. Number two, if the child is disabled, you remember that disability, 80U disability, in that case a child can get some from the government, some money can be received by the child, then also that money will not be clubbed in the hands of the parent. Apart from that, whatever income is there of the child, you have to club in the parent who has the highest income. All income of minor shall be clubbed in the hands of parent whose total income or whose total income other than his income is higher. Now, sir, how to know which parent has more income? You, let's say for example, husband or mother, father, mother. Father has a 10 lakhs income, taxable income, and mother has 6 lakhs income. Now, before clubbing, you will check this, not after clubbing. Before clubbing, who has a higher income? Father. So, club in father's income. Getting it? Next. Income earned by manual work or skill not to be clubbed, which I just now told you. Manual work means any work he has done or singing, dancing, anything. If parents are separated, maintaining parents shall pay tax. So if parents has divorced, whoever maintains the child in that parent's hand, it will be clubbed. No clubbing if child is disabled under 80U and any amount out of disability has come, no clubbing will happen. Clubbing will happen even if minor daughter is married, guys. Even if minor daughter is married, clubbing will happen, and we have just now seen. Guys, mind you one thing. Whenever you club the income, let's say for example, here we saw that father's income is 10 lakhs, and let's say for example, some 1,20,000 minor child income has to be clubbed here, has to be clubbed. In that case, father will get 1,500 deduction he will get, guys. Are you getting it? At the time of clubbing? But this deduction will be applicable only if father pays tax under optional tax regime. It will not be available under default tax regime, guys. Very, very important. Flat 1,500 exemption per child under optional tax regime you will get. Rental income from house property, just now I told you, shall be taxed in the hands of transfer or parent as a deemed owner under income from house property, but one exception. In case of minor married daughter, Transferor of house property will not be treated as deemed owner, and clubbing will happen in minor married daughter. Now, these are some important points. Income would include loss also. Guys, it may happen. No, now see, let's say, for example, husband gave money to wife. Wife invested that money in some shares and incurred some loss. You know what? Even this loss will be clubbed in the hands of the transferor husband, guys. It is not just income. Yes, and this loss he can actually take the benefit of set off of a carry forward of loss benefit he can take. So law here, income we are discussing, but income would also include loss as well, guys. If there is a loss generated, that would also be clubbed. Where asset is transferred is converted into other form, then income from such a form is also derived, has to be clubbed. If asset transferred is sold by the transferee, this is very important, guys. If asset is transferred, let's say for example, guys, husband transferred to wife one building transfer, rental income, nothing is coming, self-occupied by wife. Now this building was sold by this wife in future to someone, capital gain will come. That capital gain also will be clubbed in the hands of husband. That is what this provision is trying to say. So what is it trying to say? Very important, guys. If asset transferred is sold by the transferee, the capital gain also shall be clubbed, guys. I hope that is clear. Now comes the next topic, which is set off and carry forward of losses, guys. Set off and carry forward of losses. Now, guys, very important. Every attempt 6 marks is definitely asked from this. Guys, in set off and carry forward of losses, 2 points you remember: intra-head adjustment, inter-head adjustment. Intra-head adjustment means within the same head. Let's say for example, house property 1, house property 2. You have 2 house properties. House property 1 has 3 lakhs of income, and house property 2 has loss of 1 lakh. If you can set off this 1 lakh with 3 lakhs, that is called intra head adjustment. 2 lakhs only net income from house property which you will offer it to tax. This is called intra head. Within the head you are adjusting the loss with the other income. But let's say for example, let's say for example, next inter head adjustment means this is PGBP. If you have a PGBP loss of 1 lakh, house property you have an income of 3 lakhs. If you are setting off this PGBP loss with house property income, and the net house property you are offering to tax is 2 lakhs, that is called inter-head adjustment. One head income with other head loss, that is called inter-head adjustment, guys. Yes, so intra-head means within the same head if you are doing the adjustment of loss. Intra-head adjustment means set off of loss with the same head of income. Inter-head adjustment is set off of loss with other head of income, that is called intra-head and inter-head. Keep in mind one very important point. Inter-head adjustment can only be done in the year of loss. Means adjustment of one head income with other head loss, you can do it only in the year in which you incur the loss. Once you carry forward the loss, you cannot do inter-head adjustment. Let's say for example, year 1, you have house property income of 3 lakhs. Very important. Keep in mind this thing. You have PGBP loss of 5 lakhs. This 5 lakhs you set off with this 3 lakhs. This is because this is the year in which you incur the PGBP loss. No problem. Now 2 lakhs loss is there still 2 lakhs loss pending, that you will carry forward to the next year. Next year when you will go, let's say for example, PGBP income is only 50,000. House property income you have 2 lakhs. Now you see here, 2 lakhs you carry forward to the next year. 50,000 PGBP income is there. So out of this 2 lakhs loss, 50,000 you will set off with the PGBP income. Now still 1,50,000 loss is there, that you cannot set off with this 2 lakhs, though there is income, guys, because I told you this inter-head adjustment is possible only in the year in which you incurred this loss. Once you carry forward the loss, you can only set off with the same head of income. You cannot set off with other head of income, guys. Very important point. Keep in mind this thing. Now, that's what is given here also, guys. Inter-head adjustment can only be done in the year of loss. Carried forward loss cannot be adjusted against any other head of income. Now, these are the steps how you actually set off. Head of income steps for set off and carry forward of losses. Guys, always remember one thing. First, you have to set off within the same head. Still any loss is pending, go and set off with some other head. But provided this is the this year loss, correct? You will set off with the other head. Still loss is there, carry forward to the next year. Once you carry forward, you will be eligible to set off within the same head, not with other head income. Salary, any loss possible? Not possible. Next. House property. Intra-head adjustment under both the regimes, it is possible. Within the same head, possible. Inter-head adjustment means with other head of income, you can only set off under optional tax regime, that to maximum 2 lakhs only, guys. Very, very important point. Very, very important point, guys. Guys, house property loss, if you have, you can set off within the same head without any limit under both the regimes possible. But if you want to set off the house property loss with other head income, you can set off only under the optional tax regime. So there is a cap of maximum 2 lakhs. Now you know one more thing. After this set off of 2 lakh rupees, if you have any loss pending, if you have any loss pending, that also you can carry forward or not. Now you see, if you are paying tax under the default tax regime, you cannot set off any loss, guys. If you are paying tax under the default tax regime, loss under house property, you cannot set off under any other head. And if there is, let's say for example, you did intra-head adjustment. See, under intra-head adjustment, you can do, under the default tax regime, you can do intra-head adjustment. If loss is still pending, you cannot carry forward that loss under default tax regime. But under optional tax regime, once you set off, still loss is pending, you can carry forward. But under default tax regime, neither you can set off with other head, nor you can carry forward to the next year. Loss has to be just ignored like that. Next, remaining loss you can carry forward to the next year, next 8 years, only under optional tax regime. This you can do, guys. PGBP, there are 3 kinds of businesses, guys. Normal business, speculation business, specified business. Now, guys, whatever business is there other than specified business and speculation business will be called as speculation business, guys. Remember, speculation means intraday trading. Within the same day, you purchase the shares, you sold the shares without a delivery. But guys, keep in mind one thing, guys. I think I wrote here. 1 second. Guys, I'll write some terms here. Very, very important. Derivatives, futures, future contracts or forward contracts. These are not speculation business, mind you. This looks like a future, forward. No. Derivatives, these are not speculation, guys. These are normal business only. Keep in mind, very, very important, guys. Next. So in speculation business, guys, always keep in mind one thing. Speculation business loss can only be set off with speculation business income. You cannot set off with specified business income. You cannot set off with normal business income. You cannot set off with any other income, guys. If you have income, set off, otherwise carry forward to the next year. Speculation set off against only speculation business only. Inter-head adjustment not possible, and you have to carry forward to the next 4 years maximum. Same with the specified business also, guys. Specified business loss you can only set off with specified business income. You cannot set off with any other income, guys. And if other head adjustment possible, inter-head adjustment not possible. Intra-head not possible. How will you do inter-head? So it is not possible, and you can carry forward to unlimited years. You can carry forward. Now, short-term capital loss, guys. Short-term capital loss can be set off with short-term capital gain or long-term capital gain. Are you getting it? Short-term capital loss can be set off with short-term capital gain or short-term capital long-term capital gain. Short-term set off against the short-term capital gain or long-term capital gain. There is no inter-head adjustment possible for capital losses, guys. Keep in mind, very, very important point. Capital, guys, one thing I'll tell you. If you have very much confusion in set off and carry forward of losses, I have uploaded 1 hour video on my channel, Tax Thalaiva channel. Just a YouTube, you type Tax Thalaiva. In that, set off and loss of carry forward one, beautiful, guys. Because in this topic, guys, 1 second, in this topic, guys, 100% sure 6 mark question definitely it will come. If you want that laddu 6 marks in your pocket, Tax Thalaiva, you type on your channel, you will find a set off and carry forward loss. Beautifully I have explained. 1 hour you will finish it off, guys. Yes. Now, so specified business loss you can only set off with specified business income. That too under optional tax regime only. No, because specified business, I told you already, under default tax regime, there is no 35 AD concept only. Inter-head adjustment not at all possible. And the remaining unlimited years you can take. Short-term capital losses, long-term capital loss now. Long-term capital loss can only be set off with long-term capital gain. Yes. See, guys, I'll draw one thing. This is small. This is big. Correct? You can fit this into this. But can you fit this big into small? No. So that's why long-term capital loss cannot be set off with short-term capital gain. But short-term capital loss, you can set off with long-term capital gain. Got it? Next, next, next. Income from other sources from loss of owning and maintaining racehorses can only be set off with loss and from gain of owning and maintaining racehorses. Remaining we have to carry forward to next years to the maximum of 4 years. Income from other sources, any other loss you have, intra-head adjustment possible, intra-head adjustment possible, but carry forward is not possible, guys. Okay, now there are some important points. All losses can be carried forward only if income tax is filed mandatorily within the due date. You know there is a due date of filing return of income. If you file the return of income within due date, only then you will be eligible to carry forward the loss. Otherwise, carry forward of loss is not possible. But there are some exceptions, guys. House property loss, unabsorbed depreciation, you can carry forward even if return of income is filed late, guys. Business loss can be carried forward set off only with the by the same person. Successor of business cannot set off brought forward losses except in case of inheritance. Let's say for example, I had a business. My business had a loss of 5 lakhs. I sold my business to someone. He bought my business, but he cannot carry forward this 5 lakhs of loss from me to him. Are you getting it? Next. Loss from lottery, card games, guys. Winning losses, just ignore, guys. Nothing is going to happen. No set off, nothing will happen. Next up. Same 115BB, same thing, guys. TV shows the same. Brought forward business loss can set off even if such business is discontinued. You can set off. Means I had a business loss of 5 lakhs. Now business closed. I did not sell that business to someone. Business is closed. That brought forward business loss I can set off still though the business is closed, guys. So that closes our discussion on the set off and carry forward of losses. The next topic is TDS and TCS, guys. You can download this TCS PDF in my YouTube channel Tax Thalaiva. You will find TDS TCS revision 1 video. In that video's link there is a Google Drive link. Click on that link, you will find this chart. You can download summarized version of TDS, guys. Very simple. I have put it in a very simple columns, and you can download that. PDF is there actually. You can download from there. First section is 192. You know 192 salary. Whenever an employer pays salary to the employee, the employer has to deduct TDS on the salary on the average rate based on the slab rate which is opted by the employee. 192A, premature withdrawal of EPF. If the limit is given 50,000 rupees, if you withdraw from your employees provident fund account any amount more than 50,000, if you are withdrawing, then the TDS rate will be 10%, guys. 193, interest on securities, guys. If you are receiving interest on securities, let's say for example you invested in some debentures, if you are receiving an interest, and if you are receiving interest of more than 10,000 rupees, 10% of TDS rate will be applicable. 194A, interest other than interest on securities, means let's say for example you gave loan to your friend, you took a loan from your friend, you have to now pay interest. On that interest you have to deduct TDS at the time of making payment, guys. Now normal case is 5,000, means your friendly transaction 5,000. If you are paying interest more than 5,000 to your friend, you have to deduct TDS at the rate of 10%. But interest paid by bank, let's say for example you have a fixed deposit with the bank and the bank is paying you interest. In that case, if you are receiving interest more than 40,000, then the bank will deduct TDS at the rate of 10% on your income. If the bank pays interest to a senior citizen, then the bank will deduct TDS only if the interest is more than 50,000. At the rate of 10% it will deduct, guys. Next, 194, dividend. If you are receiving dividend, the company has to pay dividend. At the time of paying dividend by the company will deduct TDS at the rate of 10% if the dividend amount is more than 5,000 rupees, guys. I have highlighted these in one common color. If you see this, I will discuss just now. But first, let's discuss the general provisions. Then I'll come to what exactly is this highlighted color. Okay, next. 194B, lottery crossword winnings, guys. Any winnings you see, straight away the TDS rate will be 30%, guys. Okay, so more than 10,000 winnings if you have, directly 30% will be deducted from your winnings. From online games winning, if more than 100 rupees you are getting, 30% TDS rate. Again, winnings, horse race winnings more than 10,000 if you receive, 30% straight away it will be deducted from your winnings. 194C, contract payments. Lot of times in examination this has come. Contractual payments, guys. In contractual payments, if you are making payment for a single contract and if the single contract amount is more than 30,000, then deduct the TDS. But if you have taken multiple contracts from one particular single person, then for multiple contracts, if you are making payment more than 1 lakh, all the contracts put together with a single person, in that case, you have to deduct TDS. Now, the rate will change depending on the who is the contractor. If the contractor is individual or HUF, deduct the TDS rate at the rate of 1%. If the contractor is any other person other than individual HUF, deduct at the rate of 2%, guys. Next, 194 DA, maturity of insurance policy. If insurance policy gets matured, you will receive amount that amount if it is more than 10,000 rupees, guys. In that case, more than 10,000 if you are receiving, in that case, one second, if you are receiving more than not 10,000, more than one second. Okay, insurance commission we missed. Insurance commission, guys. If you are an insurance company agent, if you receive any commission, in that case, if you're receiving more than 15,000 of commission, in that case, the insurance company will deduct TDS at the rate of 5%. Maturity of insurance policy, if an insurance policy is matured, and if you are receiving any amount more than 1 lakh rupees, in that case, up to 30th of September, if you receive 5% is the TDS rate, and on or after 2024 August, on or after 30th of September 2024, if you receive, then the TDS rate will be 2%. Commission or brokerage, 15,000 more than 15,000 of commission or brokerage if you are receiving, in that case, TDS will be deducted at the rate of 5% or 2%. Next, rent. Guys, whenever you make a rental payment for plant and machinery or land or building or furniture, in that case, keep in mind, for plant and machinery, if you took on rent and you are making rental payment, if the rental payment is more than 2,40,000, you will deduct TDS at the rate of 2%. But you took on rent land or building or furniture, rental payment you are making more than 2,40,000, the rate of TDS will be 10%. Then TDS on transfer of immobile property. Let's say, for example, I am buying a property. In that case, when I am making the payment to the seller, I have to deduct TDS if the consideration is more than 50 lakh rupees at the rate of 1%. Guys, mind you, if the sale consideration is more than if the SDV is more than the actual sale consideration, in that case, you have to deduct TDS on the higher of SDV or actual purchase price, whichever is higher. Next, rent by individual or HUF. If an individual or HUF is taking any residential house property on rent, and if the rental payment which is being made is more than 50,000 per month, if I make more than 50,000 per month for rental of a house property, in that case, I have to deduct TDS at the rate of 5% or 2% depending on when I am making the payment. 194J, professional or technical fees. Guys, mind you, in this case, 30,000 for each service. Let's say, for example, from one particular person, I have taken 2 professional services. For each professional service, I will see 30,000 limit. So if I am making payment more than 30,000 rupees for each service to any person, I have to deduct TDS at the rate of 10% or 2%. If I am paying for professional services, 10%. If I am making payment for technical services, the TDS rate will be 2%, guys. 194K, income from units. If I am making payment, or let's say, for example, if any company is making payments on the mutual fund units which I am holding, so that company will deduct TDS if the income is more than 5%, 5,000 rupees, and the TDS rate will be 10%. Interest on compulsory compensation. So compulsory acquisition will happen. The compensation which I will receive, if it is more than 2,50,000 rupees, government will deduct TDS at the rate of 10%, guys. Next, contract 194M. Guys, if you are making payment for contract or commission or profession by individual or HUF, 50 lakhs is the limit. Now I'll tell you. Guys, see here. This means 194J, 194I, 194H, 194 C, 194, one second, 194A, 194C, 194H, 194I, 194J. These sections, guys, keep in mind one thing. These sections, under these sections, the payer has to deduct TDS only if his turnover or gross receipt is more than 1 crore or 50 lakhs. If it is less than 1 crore or 50 lakhs, he is not required to deduct any TDS. But keep in mind one thing. If any of these nature of payments is being made, contract, commission, professional fee by this individual whose turnover is less than 1 crore or whose gross receipts is less than 50 lakhs, if any of these nature of payment is being made and that payment aggregate is more than 50 lakh rupees, then he will be triggered under section 194M and TDS shall be deducted at 5% or 10%, guys, mind you. So this is applicable only for individual HF other than covered under C, H and I, guys. Got it? And J. Yes, next 194N, cash withdrawal. If you withdraw any cash from the bank, in that case, if you return of income all filed for all three preceding previous years and you are withdrawing up to 1 crore, in that case, return of income all three previous years not filed and you are withdrawing up to 20 lakhs, or you are a cooperative society withdrawing more than 3 crores. I repeat, if you are withdrawing cash and you have to check return of income all three preceding previous years whether filed or not. If you have already filed, in that case, if you withdraw more than 1 crore, TDS will be applicable. Bank will deduct TDS. But you did not file the return of income for the three preceding previous years, then if you withdraw more than 20 lakhs, then only TDS will be deducted. But if you are a cooperative society and cooperative society is withdrawing cash from the bank, then a 3 crore limit is there. So more than 3 crores, if the cash is deducted, cash is withdrawn, then only TDS will be deducted. Now, at what rate the bank will deduct? Return of income you have filed for all the 3 years, in that case 2% TDS rate they will apply. If you have not filed the return of income for the 3 previous years, in that case 2% will be applicable from 20 lakhs up to 1 crore of cash withdrawal. If you withdraw above 1 crore rupees, 5% of TDS will be deducted. And for cooperative societies, 2% is the TDS rate. Now, senior citizen bank deduction. Guys, for senior citizen bank deduction, guys, only pension and interest from bank if it is received and there is no other income, in that case, as per slab rate, the bank will deduct, guys. Purchase of goods. If, let's say, for example, I am purchasing goods from one particular vendor. My previous year turnover is more than 10 crores and I am purchasing goods worth more than 50 lakhs from a particular single vendor. In that case, I have to deduct the TDS at the rate of 0.1% if the amount is more than 50 lakh rupees. Yes, are you getting it? Next, TCS provisions. Guys, if you ask me what are the important sections, right? Yes, 194A, 194, 194C, 194H, 194I, 194IB, 194IA, 194M and 194Q. These sections you please focus and go for examination. Now comes the TCS provisions, guys. Now, under TCS, very simple, guys. For alcoholic liquor, tend to leaves, timber, everything, you have to see this TCS rates. And for leasing of toll plaza and all, 2%. For sale of motor vehicle, this sometimes comes in examination. If you are buying any motor vehicle more than 10 lakh rupees, the seller will collect TCS at the rate of 1% from you, guys. Next, foreign remittance. If you are remitting any amount, guys, this is also important, guys. If you are remitting foreign exchange abroad, you have to convert your rupees into dollars, right? For that conversion, if you are remitting any amount abroad for other than education or medical purpose and for more than 7 lakh rupees, then the TDS rate will be 20%. TCS rate, TCS which will be collected by the foreign exchange fellow will be 20%. But if you are remitting for education purpose, loan funded means you are taking loan from Indian bank, you are converting this Indian loan amount into foreign amount. Then in that case, if you are converting for more than 7 lakh rupees, then 0.5% TCS the foreign exchange forex fellow will collect. And foreign remittance for education, not loan, means your own money, you want to pay fees abroad, you want to convert that into the foreign dollars. In that case, own money more than 7 lakhs, if you do own funds, 5% TCS will be collected. Overseas tour program, if you want to take any amount you take, guys, up to 7 lakhs, 5% of TCS they will collect, and above 7 lakhs, if you convert the Indian currency into foreign currency, 20% TCS will be collected. Now, sale of goods, 206CH. Just now I told you, if I am buying any goods from a vendor for more than 50 lakh rupees, at the time of making payment, I have to deduct TDS at the rate of 0.1% under 194Q section. But look at the seller side. If the seller is selling any goods to the buyers and the seller's previous year turnover is more than 10 crore rupees, and if the seller sells any goods more than 50 lakh rupees to a particular vendor, in that case the seller has to collect TCS at the rate of 0.1% from the buyer, guys. Next, 10AA SEZ, guys. Sometimes a separate question may be asked from SEZ. Very simple, guys. If you have a unit in a special economic zone, and if you export the uh, you do only export sales, then whatever profit you earned by doing export sales, the total profit will be exempt. This is the basic concept. Now let's see, manufacturing or production is very, very important. I'll highlight some points here. Manufacturing or production unit you set up in SCZ unit, guys, or a provision of a service, also any service or manufacturing or production of any articles or thing, any of these activities you are doing in your unit in a special economic zone. In that case, you received approval up to 31st of March and you begin operations before 31st of March 2021. In that case, plant and machinery used in SEZ business shall be new. These are all the conditions, guys. Remember 35 AD, I told you plant and machinery should be new, but up to 20% it can be second hand machinery. Plant and machinery imported will be treated as new plant and machinery only, and you should get your books of accounts audited and written off income should be filed. Now see here, guys, if you set up a unit in special economic zone for production of any article or thing, or for provision of any services, and you started your operations before 31st of March 2021 and you got approval before 31st of March 2020, and the plant and machinery which you invested in this SEZ unit is totally new, but up to 20% it can be second hand, and plant and machinery imported will be treated as new only. You have to get your books of accounts audited and written off income is mandatory. If you satisfy all these conditions, guys, in that case, how much reduction you will get? For the first 5 years, when you started operations, from first 5 years, 100% of export profits, guys, mind you, SEZ unit can do two kinds of sales: domestic sales and export sales. Means within the country it can sell the goods or it can sell outside the country. Mind you, you will get 10AA deduction only on export sales, export profits, not on the profits which you earned by doing domestic sales, guys. Okay, so 100%. Then next 6th year to 10th year, 50% of export profits, and 11th year to 15th year you will get lower of the following: amount transferred to SEZ reinvestment allowance reserve or 50% of export profits. You will get a deduction like this, guys. In questions sometimes they'll give you previous year, you have to check whether you are in 6th year, 10th year, 11th year, 15th year, whatever. Accordingly you will apply this. Now how to find export profits are very simple, guys. Think logically. Export profit will be PGBP. Means what? PGBP of the full unit. Yes, full units PGBP you will take, means the profit from the full SEZ unit you will take, multiply with export turnover divided by total turnover, that will give you the export profit, guys. Yes, next, export turnover means the proceeds of India brought into convertible exchange within 6 months. Guys, there is one condition: export turnover, once you do within 6 months of you doing the export turnover, all the proceeds have to be received in India. Only then that will be eligible for export profit calculation. If let's say for example I exported some goods 8 months back, I did not receive any money from my buyer from outside India, I did not receive any money yet, 6 months already over. Now that profit what I made out of that export sales which I could not realize within 6 months cannot be called as export profit. I will not be eligible to get any kind of deduction under 10AA. I hope that is clear, guys. Yes, very, very important. Sometimes it is asked in examination. Now comes the alternate minimum tax. Guys, alternate minimum tax is applicable only in case of all assessees except company, guys. In companies it is not applicable. All other individual HF, AOP, BOI, everyone, you can apply this AMT concept, guys. Now AMT will be applicable only if you are claiming either 10AA deduction, which is SEZ, or 35 AD specified business, 80JJAA deduction. Yes, 80JJAA generation of new employment, ET, QQB, RRB, royalty and all. Yes, only if you are claiming any of these deductions, then only you will calculate alternate minimum tax. Now, alternate minimum tax, how do you compute? First of all, you need to do adjusted total income. How do you do adjusted total income? Very simple. Take normal total income as per normal. Guys, total income means what? You will claim. First, you will take gross total income less chapter 6 deductions. That will give you total income. Total income as per normally you do. Normally as per the normal provisions of the Income Tax Act. Then add back. Guys, when you will do normal, see, gross total income is there. From that, you will reduce chapter 6A deductions. In chapter 6A deduction, 80 double J double A, 80 QQB, 80 RRB, everything will be there now. And in this gross total income, when PGBP is there, in that you would have claimed 35 AD and 10 double A and all. Correct? Correct. Now, you already claimed as per normal provisions, this total income you computed. Now, whenever you do adjusted total income, you have to add back all these deductions which you claimed as per normal provisions. So add back deduction under 10 AA, 35 AD, 80 JJAA, QQB, RRB, again add back. Then reduce depreciation under section 32 on 35 AD capital asset. Mind you guys, when we claim 35 AD, we do not claim depreciation on the capital asset. Correct? Now, once you add back this 35 AD deduction here, then you are eligible for depreciation. No. So depreciation under section 32, you will calculate on the 35 AD asset, you will calculate here and reduce. That will be your adjusted total income. Now what you will do is, you will take the adjusted total income. On that, you will calculate 18.5% of adjusted total income as the alternate minimum tax. You will compare it with income tax as per normal provisions of the act. Whichever is higher will become your tax liability, guys. Alternate minimum tax. Now guys, what happens, because you are claiming this big sections as deductions, your income will fall very less. So you are paying very less tax to the government. So government told, wait, you have to minimum ensure that you are paying 18.5% of adjusted total income. So that's why we are calculating this. So first step is what? You have to check whether you are a assessee apart from a company. Number two, you will check whether you are claiming any of these deductions, 10 AA, 35 AD, 80 JJAA, 80 QQB, 80 RRB and all. Then you will calculate the adjusted total income by following this method. You will take two things and compare. Number one, normal income tax liability as per normal provisions of the act, and 18.5% of adjusted total income, whichever is higher will become your actual tax liability. Now keep in mind one thing, guys, very important. This AMT provision means this comparison of these two taxes you will not require to be done if this adjusted total income is up to 20 lakhs. So let's say, for example, when you computed this adjusted total income, it came to 18 lakhs. Then no need to compute alternate minimum tax liability payable. Nothing required to be computed. Go and compute your tax liability as per the normal tax provisions only. Let's say, for example, this adjusted total income came 21 lakhs. Then only on this 21 lakhs, 18.5% you do. Then income tax payable as per the normal provisions of the act on the normal total income, whichever is higher, that will be your alternate minimum tax, guys. Yes, next comes the total income computation, last final topic. Guys, there are two topics which are missing here: deductions and return of income. Deductions, a separate video is available on Tax Thalaiva channel. Go in detail in just 1 hour I have explained. Return of income also in just half an hour I have explained the return of income on Tax Thalaiva channel. You go YouTube channel Tax Thalaiva, you will find a separate video. You can cover from that, guys. I am not covering here. Yes, now we will discuss total income, guys. Guys, total income is the first question which is asked in the examination. Very important, guys. Now in total income, what do you do? First, you will take all the 5 heads of income. Generally, you will compute as per the provisions whichever I taught you just now. Under every head of income, you will compute. That will give you gross total income. From the gross total income, you will reduce the chapter 6 deductions only under optional tax regime. Now, mind you, under default tax regime, only 80 CCD2 to 80 CCH2 and 80 JJAA. Only these three are eligible under default tax regime. Rest all are eligible under optional tax regime. You will reduce, that will come your total income. That is fine. How to compute tax liability, sir? Now, while computing income tax liability, total income, guys, in question, in total income, guys, I have uploaded one video on my YouTube channel, Tax Thalaiva, where I have explained all the models of total income computation, guys. If you want, you can go and watch there. Beautifully, I've explained. You have any kind of fear of total income computation, just 1.5 hour video it is there. You will get full clarity, 15 marks laddu in your pocket, guys. Pakka. Now, the important points which you will keep in mind at the time you will compute your total income tax liability. Guys, lot of times in question, always read the demand of the question, guys. If you do not read the demand of the question, you will get 100% wrong answer only. You should read whether they are asking you to compute the tax liability under both the tax regimes or only one regime, that too which regime, default tax regime or optional tax regime. If you do not know though, if you do not read that, how will you understand what is the demand of the question? Then you will go wrong, you will not score any marks. Now, new slab under 115 BSE is default tax regime. Some important points I want to share with you regarding total income. New slab, whichever is there, 0 to 3 lakhs, 3 to 7 lakhs is default tax regime. Deduction under chapter 6 are not available under default tax regime except 80CCD2, CCH2 and JJAA. This we know. Deduction under chapter 6 are not available from the following incomes. Very important, guys. Chapter 6A deductions you cannot claim under 112, 112A, 111A and winning. These special incomes are not eligible to claim chapter 6A deductions, guys. Very important. You cannot claim chapter 6A deductions against these incomes. Be very careful. Means these are special incomes. You cannot claim chapter 6A deductions against this. Basic exemption limit of 2.5 lakhs or 3 lakhs or 5 lakhs under optional tax regime and 3 lakhs under default tax regime not available against the following incomes. Means the basic exemption limit you cannot claim under these two incomes. What are these? In case of a resident, winnings income, and in case of a non-resident, any income taxable at special rates like 112, 112A, 111A winning. These against these incomes you cannot claim basic exemption limit. Means you have to definitely pay tax. Definitely. Next. Rebate under 87A not available under long-term capital gain 112A and winnings under both the tax regime. This we discussed again under the rebate concept we already discussed. Next. Priority of paying taxes. Sir, how do I compute tax, sir? First of all, guys, winnings you pay 30% straight away. 112A on the excess of more than 1,25,000 you pay 10%. 111A pay at the rate of 15%. This is a new rate, guys. This is new rate 15%. LTCG 112 20%. Guys, here actually 112A it can be 12.5% also new rate, and this can be 20% also new rate, old rate. Both are given here. And LTCG 112 20%. Once you compute all these tax liabilities on the other income slab rate you will apply. Correct? After reviewing basic exemption limit from the total income, apply this priority. First you will take total income. From that, first you will reduce winning income, then 112A, 112A, 111A, 112, everything. Then the other income, whatever is there, on that you will have to apply slab rate. Simply have to put, guys, on these incomes, apply the special rates given here. All other income, whatever you have, apply the slab rate. Surcharge capped at 15% for income under 111A. This I already explained under the surcharge concept that if your total income exceeds 2 crore rupees, you cannot claim, if your total income exceeds 2 crore rupees, you cannot charge surcharge more than 15% on the special incomes like 111A, 112, 112A and dividend income under both the tax regimes. Overall surcharge capped at 25% under default tax regime. You know very well, under default tax regime, the maximum surcharge rate is 25%. Under optional tax regime, the maximum surcharge rate is 37%. Exemptions under the head salary. There are some salary, I told you, under salary head. Specifically, I'll tell you which are the exemptions. So, gratuity, leave encashment, voluntary retirement, conveyance allowance, transport allowance. These exemptions, whatever we read, will be available under both the tax regime. Remaining all exemptions will be available only under optional tax regime. So, just remember this list and go for examination, guys. Next, deductions. Very important. I told you under salary chapter, these deductions under which regime how much available, I told you I will explain later. So here I'm explaining, guys. Standard deduction under both the tax regimes you will get it, no problem. Entertainment allowance you will get only under the optional tax regime, and professional tax you will get only under optional tax regime. So entertainment allowance and professional tax you will not get deduction under the default tax regime, guys. Be very very mindful. Standard deduction only you will get under the both the tax regime. Now interest under 24B, which we already discussed, under optional tax regime, available both for let out property and self occupied property, but keep in mind self occupied property maximum you will get 2 lakh rupees of deduction. Default tax regime only let out property you will get interest deduction. Self occupied property you will not get any kind of interest deduction under 24B. This is house property head, guys. Next, under PGBP, always keep in mind one thing. I told you all kind of deductions you can claim under optional tax regime, but under default tax regime, 10AA additional depreciation, 35 donations, and 35 AD specified business you cannot claim under default tax regime. Capital gains, all exemptions 54, 54F, 54B, 54D, 54AC, under both the regimes it is available. Income from other sources, family pension and gift, that 50,000 exemption is there, no, will be available under both the tax regimes. Under clubbing, I told you already, when you club in the parents income's hand, in that case 1500 per child the parent will get exemption. That exemption is available only under optional tax regime. So guys, this ends our discussion, guys. Three important points I want to tell you. Number one, tomorrow I will be uploading top 50 adjustments of total income computation. 100% I can say, guys, most of the adjustments in total income computation will come from this video which I'll be uploading tomorrow. Be tuned. Definitely you will get crystal clear clarity on that. So tomorrow I'll be uploading. Be tuned in this. Deductions, return of income, I already told you. Please watch from the videos under Tax Thalaiva channel. You will find it, guys. If you genuinely liked this, the way I taught you, please leave a comment, guys. For my hard work of past 4 hours, one comment, one like I deserve. And please do subscribe to the Tax Thalaiva channel and the CA Classroom Karthik Manikonda sir's channel also, guys. Yes, I hope you liked this video, guys. Yes, for the coming attempts, May 26, September 26, Jan 27, we are very soon going to come up with regular classes. So please do share a word of mouth with your friends. If you genuinely like the way I teach you, yes, please spread the word, guys. Yes, I hope this is clear. Thank you so much for being in this video, guys. Definitely, I can say one thing. You will get 100% crystal clear clarity after watching this video. Full confidence you will get. There are some additional videos which you can find on my channel also. You can watch that. Yes, no problem. And tomorrow I'll be uploading on both the channels top 50 adjustments on your channel. You will find it. Please do follow that also, guys. Yes. Okay, guys. That's all from my end. Take care. Bye bye. Namaste. Namaskara. Vanakkam. Signing off from my side. Take care. All the very best. And do very well, guys. Always focus on the demand of the question, guys. Demand of the question is very, very important. You have to attempt. See, if the paper comes very, very tough, don't worry. It is tough for everyone. Only one key, guys. One key you have to keep in mind. If the paper is very, very tough, try to attempt maximum possible. Don't just attempt 40, 50 marks and come out. No. Attempt minimum for 70 to 80 marks and then only come out of examination hall. Even though whatever you know, you write in the examination, guys, definitely you will clear. You may be thinking you will not get even 20, 30 marks, but still you will clear, guys, because ICI sometimes gives grace marks also, guys. So don't lose your chance just by not attempting. At least attempt whatever you know and come back out of examination hall. Write, neatly. Don't scribble here and there. Wherever you want to scribble, just one liner, you can just scribble like this. Okay, just one. If you want to cut off, don't do like this and all. It irritates the examiner, guys. Create a good impression. 15 minutes, first 15 minutes, try to utilize on whichever comfort zone you have, like total income computation you want to see, you can see. MCQs you want to check, you can check, or any other comfort zone you have, that particular topic you want to check in that 15 minutes. But utilize the 15 minutes very, very carefully when you get the question paper on hand. First question you write beautifully. Whichever question you feel very, very confident, attempt that question paper, that question only, guys, because the first impression is the best and the last impression, guys. So that will only carry forward to the next also, because the examiner will have very less time on hand to evaluate many papers. So the first impression itself you should give like, okay, this paper is very neat and clean, it shows the confidence of you, and you can score the highest marks possible, guys. Yes, from income tax standpoint, I bet and guarantee you guys, out of 50 marks of your question paper, minimum I'm saying 40 to 45 marks will be covered from the topics which we discussed today. So I'll not waste much of your time. Take care so much. Take care, and thank you so much for being such a lovely crowd, guys. Take care. Bye bye. See you in the coming videos. Bye bye.